We are looking ahead to the US futures. We've got S&P futures moving down by 0.2%, so not huge moves, but after a decent session yesterday. The dollar against the yen is where a lot of the action has been. Yen weakness, 150 through 150, and seems to be staying there. You'll see that the Japanese and US yield story are telling you opposite things. Clearly, the BOJ and what they've done around yield curve control, well, they've got a cap, but it's more of a sort of flexibly applied reference rate rather than a cap. Seems to be the theme there, and moving in the opposite direction to what's going on in the US, and Europe is more in line with the US this morning. What do we see on futures, Tom?
Futures up between 1/10 and 0.3%. The DAX futures looking to get back to 15,000. FTSE 100 looking to add just 5 points. The CAC is pointing up by 0.3%.
Okay, so European futures point a little bit higher, US futures pointing a little bit lower. A fairly mixed outlook then for global risk assets as we get into Tuesday's session. There we go. This is the start of the European equity session. Down by 0.1% on the FTSE 100. We've seen oil prices on the move once again this morning, just that little bit higher, not sufficiently perhaps to boost the FTSE. We'll see where BP settles on the back of its numbers, with a miss at the bottom line, but a big buyback, and so, or at least a buyback coming through from that energy major. The Spanish IBEX down by 0.4% this morning, so a little bit more weakness coming through. Vodafone could be an interesting one to watch on the London market as well. This is the FTSE MIB then, up by 0.25%. The CAC 40 up by 0.2%. So a quite great deal of divergence then coming through across these markets. Divergence in, well, as always, it's always relative on currencies. We've got the pound down 0.1%, the dollar catching a bit, a lot to do with the yen though, and yen weakness, the big theme of the morning. We talked about that just before the start of the European trading day. The changes, the tweaks that we're seeing at the BOJ, the lack of clarity around what they mean has at least resulted in a fairly firm weakening of the Japanese currency through the 150 mark. And this is the buying of sovereign bonds that we're seeing, and the yields coming lower in the European session. That's in keeping with what we're seeing over in the United States. The Japanese story, though, of course, looks a little different today, and a mixed picture on commodities then, Tom. What do you see on sectors?
A mixed picture across these sectors as well. You've got 4 now main sectors in the red. The biggest selling coming through for energy as a sector, down almost 1%. Of course, BP is part of that play as well, with a miss around the earnings, despite that $1.5 billion buyback that you were mentioning, Anna. Autos is also down just 0.1%. We've had some movement in terms of the strike action. Stellantis coming out with their earnings, though. Strike action I was talking about in the US with the Auto Workers Union there. Banks also down just 0.1%. But again, the heaviest losses coming through for the energy sector at this point. In terms of the gains, a little bit of upside coming from industrials, up 0.3%. Financial services, food also posting gains between 0.2 and 0.5%. Utilities gaining at 0.4%. So there's a very mixed picture across these major sectors so far this Tuesday morning. Again, across the European benchmark, a gain of 0.1% at 431 on the stock 600.
Okay, some interesting regional divergence then, and sector divergence this morning. Complicated picture. Sam Unstead joins us from our equities team, from the Markets Today blog, to take us through where we are on some of the bigger picture themes around these markets. Sam, let's start with one of the elements, I suppose, that could be guiding nervousness around sentiment this morning, and that's the latest out of China. Quite underwhelming when a lot of people are asking, have we bottomed on China data?
Yeah, and it seems like every time that question gets answered, there's a little bit more of a disappointment. And I think with the factory output in particular, we're back into contraction on those measures. That was unexpected. That is, as you say, I think the key thing there is at the moment is sentiment. And it is at the moment very difficult to really measure, is China starting to turn around? Is more stimulus needed? What is that stimulus? And swirling questions as ever around what China needs to do.
Just very anecdotally, every single person I speak to in China in recent weeks has been very, very pessimistic about their prospects and the prospects for that economy. But that is just anecdotal. On the chip space, switching focus to Samsung, there was a big beat there for Samsung.
Yeah, profit way ahead of expectations. But I think what is being taken from this on a more macro level is that they see the memory chip industry recovering. So people have been looking for this for a long time. Capacity got cut as demand started to fall. That appears to be taking a turn now. We actually saw this as well last week from Intel's results. You're seeing some growth again in personal computer sales. So it looks as though that may be turning a corner. And remember, of course, the chip industry, very important for global supply chains. So this one area of potential positivity going into next year.
Okay, let's talk about where expectations are for profits and for where stocks are heading. Wall Street cutting its S&P 500 expectations as geopolitical risk rises. This is interesting to me because I was also just reading around JP Morgan's Marcus Kalanovich talking about how Wall Street expectations of double-digit profit growth are divorced from the risks. Well, maybe we're seeing the markets kind of catching up with some of those risks.
Yeah, maybe they are no longer quite so divorced from those risks. You know, I think you've got volatile bond markets, you've got volatile oil, which is then linked to these geopolitical concerns, higher for longer interest rates. All of this appears to be cohering to really damage the fourth quarter outlook and then potentially into 2024 too. So you're seeing a lot of analysts starting to downgrade their estimates for the S&P 500 for the end of the year. And I think actually, as Mark Cudmore said earlier, the earnings have been broadly in line with expectations, if a little weaker, but the outlooks have often been a much more negative than had been anticipated. So it seems like some of that positivity for a kind of Santa rally is not there anymore.
Okay, Sam Umstead from Our Markets Today blog. Thank you. You can get more, of course, from Sam and the rest of the team on the front page of the Bloomberg UK website or by typing TLIV GO on the terminal. Let's get to the central bank action of the day, and it is, of course, the Bank of Japan further loosening its grip on bond yields while remaining the last of its peers to cling to a negative interest rate in a decision that prompted a retreat in the yen, and the currency remains under pressure. At his press conference, Governor Ueda said he doesn't see 10-year bond yields rising significantly beyond 1%. For more, let's bring in Bloomberg's FX and rates reporter David Finnerty. David, what is your assessment then of what we've been hearing from Ueda and the changes in the language around that 1% level and the changes to the inflation forecast? What is your take on what we've been hearing from the BOJ?
Well, again, it's another tweak, a very slight tweak towards policy normalisation. You think they've done this as the third one. They were December and July, and now this one. This one's the mildest of them all. But it is the idea that, look, at the end of the day, Japanese yields, if need be, can go above 1%. Now, how much above 1%, of course, is always a bit vague. But the point being is that used to be a hard cap, so they are letting it go up. Now, that, of course, will support the yen. And in terms of inflationary pressures, they did revise their forecast for the next 2 years. But the year after that, they actually had it below. They did rise it higher, but it's from 1.7 to compared to 1.6 prior. It's still below over 2%. So they're still playing dovish in the long term. They'll continue to say they're looking for these wage gains to materialise that will make them happy. Now, of course, we have to remember that the fact that they've revised this year's and next year's forecast so high, you'd have to think, well, something 2 years off. Yes, it's not 2%, but that could change very quickly. So, but I do think in the near term, where Japanese yields really head is really dependent on US yields. If US yields push higher, particularly depending on what the employment cost index does today, if that comes in above estimates, they could bring yields higher, US yields higher, and where they go, Japanese yields are more than likely to follow.
Yeah, and there seemed to be a lot of reference to that yield differential, David, today from both Ueda and also from the Japanese government, as if that is the thing that is to blame for what's happening in FX markets, and some people would agree and others would point to other factors. But does that mean that that there's less reason for the BOJ to interfere? Is it if it is all about interest rate differentials rather than anything else?
Well, I think the BOJ or the MOF, Ministry of Finance, I think they've always been worried about the level of the yen. They've said there's no specific level, but they've given themselves plenty of room to wiggle room to enter if they need to. They've always been worried about how much the yen is going to weaken. So I think even with today's decision, what it does do, if the yields do push up higher, above 1%, it does support the yen to some degree. But if dollar yen, I think, pushes up certainly towards last year's high of just under 150. 52, then the market's definitely going to be looking for MOF intervention, and the market likes to prod the MOF. So if it sees the chance to test its resolve, I think it's more than happy to try so.
Yeah, and we get some data today, don't we, that'll reveal whether we got that intervention earlier on this month, so we'll look at that with interest. David, thank you very much. Bloomberg's FX and rates reporter David Finnerty. Coming up on the programme, BP drops after third quarter profit misses estimates. We'll get more on that and other stocks moving this morning. That's next. This is Bloomberg.
CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
Today's CFO has to be much, much more than a bookkeeper.
One of the most important things is looking around the corner.
We have to let go of the traditional legacy department store.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
You also have to be credible business leaders in order to really impact the business and steer the direction.
We are like biologists. We need to deeply understand the financial DNA of a company.
People just come with a playbook and say, okay, we're going to roll that. Don't do that. Think longer term.
It's an amazing time to be in this role. It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the chief future officers of some of the world's most influential companies. A new episode every month, only on Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
The markets count down in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
This is Markets Today. We're 11, almost 12 minutes into the European trading day. You're seeing very modest gains across the European benchmark. Stock 600 of 0.1%. Top of your list, real estate getting 0.8. Bottom of the list, energy down about 1%. Let's check in on some of the individual stocks on the move then with Joe Easton. Joe, what is standing out to you?
So starting with BP, Tom, this one dropping now down around 4%. That's actually the biggest decline for almost 5 months for that company. They did announce a $1.5 billion buyback, but their gas business weaker than expected, and they are getting diminishing returns from those buybacks, it seems, at the moment. They've already done $7 billion this year to date. In terms of some other movers, we've got Rolls-Royce upgraded over at Barclays. This one up 3.7 in London. That is the best performing stock on the European market this year already. AB InBev, the brewer, we had a buyback from them as well. $1 billion they're doing. The Bud Light volumes continue to come down following the fallout with Dylan Mulvaney, the influencer, but that one is gaining it today. And Boyd's over in France, this is the telecoms company, strong earnings from them, so another one in last minute on some higher than expected profit numbers for them. We'll flip over. You'll be pleased to know I've run out of Halloween puns already, so we won't be getting too many more of them. But if we can get that second board, hopefully. Now I'm getting a bit of a Halloween fright. Oh, there it is. So BBVA. Now, BBVA over in Spain, they've got a credit loss impairment, but it seems to be driven by the Turkish business. They own a big stake in Garanti Bank, and they've put an impairment on there today. Siemens Energy, a bit surprising. They are potentially selling some of that India business we had in stocks to watch. It was announced just at the close of trading yesterday, but that one actually coming back down. I didn't expect to see that one falling today, I have to admit. IHG, the hotel company, now they are downgraded over at JP Morgan. They did have some pretty weak numbers last week. Revenue per room continues to decline across the hotel space. And Wärtsilä, this is an energy services company, absolutely flying at the moment, up 19%. That's the best performer on the stock 600, again related to earnings. A lot of earnings continue to come, of course, at the moment. Then on the final board, we've had a few last minute additions here. What have we got up? So Kering, Goldman Sachs downgrades the owner of Gucci for the first time in 5 years. They've had a buy rating for 5 years. They now say that that trade has played out. A couple of bits of M&A, so Vodafone. Now Vodafone, we've got news that they are selling some of their Spanish business. That broke earlier this morning. There's also a Bloomberg report on the Spanish government buying a bit of Telefonica as well. So a couple of bits of news there. Uniper, we had some comments to Bloomberg exclusively about their earnings. Seems to be positive again. That one's been hit hard recently, given some worries about a government stake sale. And finally, the last one in earnings is Thales, the defence company. That one was actually a beat on the revenue, but I think the margins might have been a little bit weaker, so that one is coming down in France.
Joe, thanks very much. Joe Easton from our equities team with the latest on some of the stocks on the move this morning. A mixed bag. Let's talk about where we are on markets with Jason De Silva, Director of Global Investment Strategy at Arbuthnot Latham. Jason, nice to have you with us this morning. So one of the stocks we were talking about there was BP, but with reference to the overall oil sector, I know that you've got an overweight on oil equities. This morning, an example of maybe a buyback being a little underwhelming compared to market expectations. What is the justification for the overweight on oil equities, given what we see sometimes with that kind of performance?
Yeah, well, good morning, Anna. Thanks for having me here today. So, look, we like oil, and, so building that up, we like the oil price because, if you think about the longer-term fundamentals in oil, I think there's a lot of underinvestment in the space more broadly. And so what does that mean ultimately for prices? Probably prices go a lot higher in the future. You're starting to see some signs that potentially the shale oil production might be peaking as well. So there's good underlying fundamentals for the oil price. And the natural beneficiary of that will obviously be oil stocks. So obviously you had the miss today in BP, but I think, across the board, there's still a commitment to capital returns to shareholders. They're lowly valued compared to the overall broader markets, and so we just like the space more.
How important is the oil story for the FTSE 100 then? Because I know you're overweight UK equities as well. FTSE 100 down 1.7% year to date. It's underperformed. What gets the FTSE 100 out of its funk?
Yeah, sure. So, if you think about 2022, that was the year of the FTSE. It was one of the outperformers. And that's when the oil price did well, oil stocks as well did well, bank stocks. So we do see the FTSE 100 being almost like a friendly stagflationary index to hold. And oil's a crucial part of that. Oil, you want to hold oil as an inflation hedge, really to protect you from any volatility in inflation. It tends to be a good, one of the best assets to hold when you have a kind of more pro-inflation view.
Thinking more about where we are on global stocks, the S&P in October had its worst October since 2018. UK stocks had their worst month this year. This has been a tough environment, hasn't it, for those who are long equities. Do you see a turn? Do you see something better by the end of the year, or do things deteriorate from here, Jason?
Yeah, sure. So, let's think about what's caused some of the equity weakness. I think it's obviously bond yields going up. And if we had to see some stabilization in the bond yields into the rest of the year, then perhaps you get some stabilization in markets more broadly. But I think it also goes further than that. Some of the tone of management guidance from earnings has been a bit tepid. Look at European corporates. They actually had earnings go down year on year. Revenues were down year on year. So there is a bit of it is a bit ambivalent of where earnings might go. So I think if we get a bit more concrete evidence that earnings could re-accelerate from here, then perhaps that might also be a push for stocks.
Are earnings expectations still too high at this point?
Yeah, I think so. I mean, if you look at profit margins, they're extremely elevated. I mean, it's the highest profit margins, over 20, 30 years. And so that's just not a good setup for earnings going forward. Secondly, we do expect some economic weakness into next year, and that will also slowly pull down earnings forecast as well. So we think at double digits in the S&P, a little bit too rich for us.
Yeah, Laurie Calvasino at RBC talking about the pessimistic tone on post-earnings calls being quite striking this time around, Jason. Is that something that you would also reflect on?
Yeah, absolutely. I mean, some of the key statements that a lot of companies have guided to is low volume, low demand ahead. They've also talked to, just a deteriorating macro. I mean, think about Meta's results. I mean, this is a company that reported revenue up 23%, and Mark Zuckerberg also pointed to potential weakness in ads and uncertain economic environment as well. So I think that's been my sense, at least.
Another big story today, of course, is the Bank of Japan, and you are overweight Japan. Does that call hold if they scrap yield curve control? They haven't done that, obviously, today, but you're benefiting with an export nation like Japan from weaker yen. Do you change that view on a significant adjustment around yield curve control?
Yeah, look, so, I mean, obviously with a very unusual monetary policy does come with its risks. But, I mean, let's think about why they would potentially loosen the yield curve control. It would be potentially because of higher inflation, which might result from stronger economic growth. So one of the reasons why we like Japan is you've got one of the few nations that have a pro-fiscal policy, easy monetary policy as well. And so that's, I think, resulted in the strong economic growth that you've seen year to date. And, I mean, GDP forecasts continue to rise up in Japan more broadly for 2023. And then you couple that with some of the bottom-up fundamentals of the corporate reforms in Japan. We know Japanese equities, Japanese companies are conservatively managed. And, if these reforms really bear weight, there could be significant outperformance from Japanese companies more broadly.
And Jason, how does China fit into your investment thesis right now, either in terms of Chinese stocks or European stock exposure to China? We had another set of disappointing manufacturing PMI data out of China.
Yeah, certainly. So I think, China, there was obviously a lot of expectations with the post-COVID recovery. Didn't quite meet that. But I think in the last month or two, we started to see some signs of stabilization. Industrial production has been strong. Retail sales have been strong. Obviously, the manufacturing data that came out was, a little bit underwhelming, but it tends to be a volatile index, the PMIs. How that might flow over to Europe. Obviously, Europe is a cyclical market, and if we start to see signs that the stabilization migrates into, good momentum into Q4, Q1 next year, that could be through to European economies.
Okay, Jason De Silva, thank you very much indeed. Director of Global Investment Strategy at Arbuthnot Latham, with a constructive view on the FTSE 100, on Japanese equities, on oil, but cautious on the earnings guidance, earnings expectations. Coming up, BP, talking of oil, shares dropping, of course, after reporting that big miss in earnings. The oil major announces that $1.5 billion buyback. We're going to break down the numbers next and look ahead for BP. This is Bloomberg.
Did come around as something that's a bit different. There is a dark side to it.
It's hard to even talk to people about these chemicals and tell them, look, there's a chemical that's in you that's not found anywhere in nature.
We've all been used as guinea pigs for the last 70 to 80 years. We weren't told we were being exposed, but they did it anyway.
This right here is the shadow fleet. To actually see clandestine behaviour was really surprising. That makes you think, well, what else is going on?
A lot of people let Agnes down. What she was told is exactly what happened to her.
It took the lid off a much bigger problem. I think that's probably the most shocking part of this whole thing.
From the beating heart of global finance, economics and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Slice through the noise.
Forget the noise. Ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal.
Now, more to the point.
What is the lesson or the observation?
This is Markets Today, 23 minutes into the trading day, and modest gains across European equity markets. That's not so for the BP share price. BP shares are lower this morning after a reported third quarter profit that missed estimates. The oil major also announced another $1.5 billion buyback. Joining us now, Bloomberg's James Heron with analysis of what's been happening. James, good morning. So let's start with the numbers then. And profits missed expectations, as often is the case. This, I guess, came down to the trading side of the business.
Yeah. So it appears their oil traders did well. They had another strong oil trading performance. Natural gas was the weakness this time. That's one area that's been particularly strong over the past year or so because of the situation with Russia-Ukraine. Companies have made a lot of money diverting liquefied natural gas from Asia into Europe. It appears that didn't quite go according to plan this quarter.
How do these results for BP then put them in terms of comparison with their peers? Where do they stand against their peers in terms of these earnings?
Well, Exxon and Chevron also missed estimates for various different reasons. And the rest of the European majors did a little bit better than expected. We've still got Shell to come this week, so we'll see how that goes on Thursday. But I think the big comparison with the peers where BP is falling short is you've seen Exxon and Chevron doing these really big deals in the US. They're really growing. They're pursuing faster growth in oil and gas. And BP, with an interim CEO, isn't really in a position to do anything like that, to offer an answer to this divide that's opening up between the US and Europe.
Yeah, there was some talk yesterday, wasn't there, about something they were eyeing in the United States. But yes, what about the leadership? Talking about leadership of the business, I mean, where are we on that trajectory? Because they're under an interim CEO, Bernard Looney, no longer at the helm of this company.
They're not saying anything new, unfortunately. They're still sticking with the line that their strategy is unchanged. They're going to pursue the energy transition, and the former CFO is now in the interim CEO role. He's doing the rounds today with the media and investors, but there's no word from the company yet on whether the interim CEO will become permanent or whether they're interviewing other people. They're keeping it very close to their chest for now.
Okay, James, thanks very much. Thanks for bringing us the story. Bloomberg's James Heron with the latest on BP. Coming up on this programme then, we will talk about Vontobel. We'll talk to Vontobel. The company sees $2.8 billion in outflows as it cuts ties with wealthy Russian clients. That's part of the conversation. We'll speak to the Swiss Wealth and Asset Managers CEO, Zeno Staub. We'll get into that conversation shortly. We'll find out more about what is driving some of those flows. We'll also get guidance for the rest of the year, looking ahead with the business, the higher rates for longer, at least relative to recent history. We'll talk about what that means for the client base. Wealth management certainly in focus, the US expansion, and also handing over the business to a new CEO, part of the conversation over at Vontobel as well. So we'll talk about all of that shortly. This is Bloomberg.
built a successful company, but you might not want to run it for the next 10, 15, 20 years, or do you? And if you didn't, would you want to go into government? If the president called you to serve our country, would you go into government, or would you start another company?
I love what I do. And I feel like I have this luxury with 23andMe that it keeps evolving. You know, we started out just as a consumer company. We're thick in research. We got into drug discovery in 2015, and now we're getting to the delivery of care. So I've been really lucky with 23andMe that it's been endlessly interesting. And I'm surrounded by incredibly talented, brilliant individuals where I learn from them. And what I always advise people to do is, like, you should take jobs where you're learning. And if you stop learning in a job, then you should quit. And, like, frankly, when people leave 23andMe, like I say, if you're not learning anymore, you should move on. So I'm 100% committed to 23andMe. That said, my other passion is other direct-to-consumer. Like, I want to build out a true consumer-empowered healthcare world, like one that is outside of the existing system. And there's no greater force than government.
City.
From London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai. Good morning, everyone.
Have a great evening. Here's what I'm watching.
You do not want to miss this story.
Is there the kind of upside? This is Markets Today, 30 minutes into your European trading day. Let's get to your top stories. The yen drops after the BOJ adds flexibility to its yield curve control program. Governor Ueda says he doesn't see yields rising significantly beyond 1%. BP drops after reporting a big earnings miss in the oil majors' first results since CEO Bernard Looney's shock resignation 2 months ago. Plus, Israel's Prime Minister Benjamin Netanyahu rules out a ceasefire with Hamas and dismisses calls to resign. The region sees more unrest as Israeli forces exchange fire with Hezbollah in Lebanon. So those are the headline stories. Tom, in terms of the market picture then, we're actually seeing modest gains across European equities.
On course at this point for a second day of gains across European equities. Gains of 0.3% across the European benchmark. The FTSE 100 is even adding 6.7 points, even managing to hold on to the green, even though BP is one of, if not the biggest loser across the European space on the back of that miss around the earnings picture. The DAX is adding 47 points, up 0.3%. On your sectors then, let's spin the board over and have a look at the energy sector in particular, because the last time I checked, that was the biggest loser. We're, of course, weighing up the data that came through from China, some of the miserable data around manufacturing, PMI back in contraction. And you also, of course, have the inflation prints out of the Eurozone. We'll get the rounded picture at around 10 a.m. UK time. But for now, the CPI that's come out of the likes of France, Spain and Germany have all been at least in line what the ECB you would expect would be hoping for. The central bank decisions, of course, of the BOE, the Fed, of course, later this week after the Bank of Japan came through with that modest, very modest tweak around yield curve control. And again, the yen remains under pressure. We're going to get the sectors board for you, hopefully. Again, the energy story, but also tech as well as a sector as yields come off across the European space. Let's zero in then on energy. Currently down 1%. That's the biggest loser across your sectors. The major sector that is in the red. On the upside, you're seeing gains for autos, travel and leisure, and food up 0.4%. Tech, there you go, up 0.5%, benefiting from a slightly softer yield environment. Industrials also getting 0.5%. Across your benchmark, you're looking at gains of 0.2% here in Europe. Anna.
Let's talk about one of the businesses giving us some insight into their current performance. Vontobel says it saw 2.5 billion Swiss francs in client outflows in the first 9 months of this year. That's as the asset manager cut ties with wealthy Russian clients and closed its wealth business in Hong Kong in 2022. For more on this, we're joined by Vontobel CEO Zeno Staub, who is with us live this morning. Zeno, nice to have you with us. So let's try and cut into the detail of what it is that's driving things here. So net outflows of 2.5 billion. But if you exclude what's going on with Russia, which is sort of well understood, I suppose, what is the underlying story here? Is this all about clients' hesitancy, reticence to put money into fixed income products? What is it that's driving the outflow story?
Yeah, first of all, thanks for having me. The underlying story is actually twofold. One, very strong wealth management. The underlying growth of wealth management remains at an annualized rate of 7%. We're growing across all markets, including our home markets. We continue to win market share based on our strengths, but obviously also based on some of the events that happened in Swiss private banking. And then on the institutional space, it's exactly what you have said. Just spent the whole last week traveling across Asia with all our clients and investors, and there is a wall of money sitting on the sideline, watching central banks, watching inflation, and trying to time this trigger point when they see exit rates to be kept and then willing to allocate. And we just are here. We're close to our clients. We know what we are doing. Our strategies are fine, and we will be ready when investors are ready.
A wall of money sitting on the sidelines. What is your sense then, Zeno, of how close we are to that point? How close we are to your clients being ready, having the confidence to put some of that dry powder to use?
Yeah, I would say two things. A, they need the next rounds of decisions from the Fed and the ECB, and we need more visibility about escalation versus non-escalation of the war in the Middle East.
Okay, so that's what investors are waiting for. Meanwhile, you've decided to not invest in your Hong Kong wealth operations, Zeno. Tell us a bit more about why you've made that decision. Do you fear that you might be missing out on future growth there?
We are very convinced that every strategy has to rest on a unique set of capabilities that answers the problem and the solution of a client better than our competitors. And what are we doing well? We do very well running money for our clients, be they institutional or privates. We are a sophisticated investment firm, and what we've learned in the direct-to-consumer space in Hong Kong is that local trading needs, leverage was more important than what we could offer given our capabilities and our risk appetite. So it was just a decision to focus. Where we are today, we tap into 85% of the global fee pool as we are active from the US to Japan, and our focus is on winning market share within 85% of the global fee pool and not lose too much sleep on the 15% we may miss out.
Well, how much sleep are you losing on the outflows then? And look, Anna touched on this, $2.8 billion in terms of the outflows. I know the performance offset that, essentially, in terms of the assets under management and the performance that came through. But do you see those kind of levels of outflows continuing in the quarters ahead, or have we bottomed for now?
We will see a little bit more as we continue to be very strict on our market focus. As we have clearly communicated, we are not in a position anymore to serve clients that are domiciled in Russia, and we have decided also to trim our Asian operations on the direct-to-consumer side. So expect a little bit more outflows out of that, but that is a clear decision that we wanted to make in order to implement our strategy. And then for the rest of the flows, let's see how fast this fixed income situation changes, because we need inflows then to obviously outweigh what we will still have to stomach on outflows.
Zeno, what's your thinking, or what's the thinking of the business more broadly around appointing two co-CEOs to take your place after you step into Swiss politics? I've been reading quite a bit recently about some fairly high-profile examples of co-CEOs who haven't delivered for the business, but then there has been some sort of more academic research that suggests this is a good setup. What's the argument in the case of Vontobel for appointing two people to the job?
Yes, first of all, this is the decision of the board, which I fully support, and I think the line of argument is very simple: strategy, structure, people. And we have a very clear strategy. We want to be that globally respected investment firm, and at the core of our drivers for success is client centricity and being investment-led. And Georg Schubiger and Christel Rondu de Lind perfectly reflect this ambition to that the success of Vontobel is driven by client centricity and being investment-led, and I have full trust that these two people bring with them the characteristics, the values, and the behavior that they can pull off a success together.
Okay, and clearly the view is that they're going to continue to kind of build out the wealth management part of the business. We have the line, the announcement that you're looking to add more relationship managers, and that makes me think of your ambitions around the US. To what extent are those hires going to be allocated to the US or are being picked in the US? And what are you looking at in terms of potential bolt-on acquisitions in that market?
Yes, so two very different answers to this question. So the majority of the hires is really focused on the booking hub in Switzerland. So on our European and our Swiss home market, we intend to grow by 15%. So the number of relationship managers year over year, end of 23 and 22, should be 15% higher. This is a significant major growth initiative. I like to call it it's M&A without goodwill in terms of the size and the characteristic of it. In our US business on the wealth management side, we just have done a major acquisition 2 years ago by acquiring the Swiss-based SEC registered business of UBS, and in that market we very clearly focus on the collaboration and the cooperation with UBS Americas. That works very well.
Okay, Zeno Staub, CEO of Vontobel, on what is likely to be your last interview with us in your current role. We appreciate your time. Good luck for the next move. The stock is down about 10% year to date, but up around 160% since Zeno took over in 2011. Coming up, a scary season for investors. So this Halloween, we're going to look at some chilling charts. Thank you, producers, in finance with Andrew Eve of M&G Investments. Stay with us. This is Bloomberg.
That's me, Max. What's up? How are you? I have been writing about Wall Street for almost 15 years. And what that means is I write about feuds and rage and rises and falls and comebacks. And every now and then, I also write about a couple of villains. Thank you so much. And now, I am about to do something new and very, very scary. We are making a show, and it's based on Bloomberg Businessweek magazine. So what is this show about? It's a show about money, power, culture, pop business. We're gonna ask complicated and profound people about their ideas, their careers, their lives, their risks, their failures, their imagination.
It's so incredibly liberating not to care what other people think.
I was giving my tools to other communities. I wanted to bring those tools home.
Tune in. Please, really actually tune in. I desperately need an audience.
This is Daybreak Europe. I'm Kriti Gupta. Let's get to the stories that set your agenda.
Taking you from the U.S. market's close.
A lot of this was priced into the U.S. session.
To the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television. The top names in global leadership are on Bloomberg.
The conflict between the U.S. and China has escalated so much. This is one of my greatest fears, that a small nation is forced to choose sides.
Bloomberg. Context changes everything.
This is Markets Today, 8:42 in London, so 42 or so minutes into the European trading day, and European equity markets are moving a little bit higher this morning. Not so in Spain. That market's still flat, weighed down by some of the banking stocks there, but elsewhere we are seeing some modest gains coming through across European equity markets. Things are going to get scary now, though. It's Halloween tonight, so it must be time for the annual M&G Investments Bond Vigilantes roundup of the scariest charts in global finance. And when vigilantes tell you something scary, you better listen. Now, one chart that stood out to us was this one, with many companies having put refinancing off for some time now. Maturity walls are closing in. Nearly 10% of high-yield issuers face refinancing risk in the next 2 years. This has the potential to become the largest refinancing effort for high-yield issuers since the GFC, the great financial crisis, if great is appropriate. Let's talk to Andrew Eve, the author of these charts, investment specialist at M&G Investments, who brings us this horror show this morning. Andrew, thank you very much for joining us. So the percentage of high-yield bonds maturing in the next 2 years does look scary. Does it look scary to you?
It does look scary. I think we've seen now we're something like 18 months into the hiking cycles of most central banks. And one of the things that's been surprising to investors is that high-yield valuations, high-yield credit spreads have remained quite resilient. Some sell off over the past few weeks, but broadly speaking, we've seen high-yield spreads get down to some of the tightest levels that we've seen since the GFC. And yet, despite this, we've got this big maturity wall coming. I think there's a couple of reasons that credit spreads in high yield have remained quite tight. Partly there's demand from yield-hungry investors, and also there's a lack of supply, because high-yield issuers, quite sensibly perhaps, have held off from issuing with borrowing costs being so high. But the other side of the coin, of course, is that with many high-yield issuers having held off from issuing bonds, we've now got maturity walls closing in. And I think this could be, as you say, one of the perhaps largest refinancing efforts for high-yield companies since the GFC.
Okay.
Can I just say congratulations on getting Anna into the Halloween spirit?
I know.
Kicking and screaming.
Absolutely. Dragged, I was.
Andrew, that's an image there for everyone. Andrew, as we meditate on the fact that Anna was hauling pumpkins around last night across North London.
Oh, well.
Andrew, in terms of the high yield risks, then, is there a region where those risks are more acute than others? Is Europe at the forefront when you're thinking about the risks around high yield? Is it Asia, US? How does it stack up on a regional basis?
I think it tends to be that the US is the riskier element of the high yield complex. European issuers tend to be a little bit more defensive in terms of the sectors that we tend to see issuing within Europe. I think one of the silver linings that we see within high yield, despite that very scary chart with around 10% of high yield issuers needing to refinance, is that if you look below the numbers there, that 10% is made up largely of the double B issuers, so right at the top of the high yield complex, the most creditworthy companies, who not only have more resilient fundamentals generally, but also perhaps face more benign refinancing costs.
Fallen angels. Sounds a bit Halloween-y, doesn't it? Let me ask you about inflation then, and you've got another scary chart for us. Let's move on to this one. Inflation, usually you say, comes in waves, and you've got a nice sort of offset of what inflation has looked like recently, and you compare it back to, you know, drum roll, the 1970s, as many people do. But does it usually repeat? Does history repeat in the way that your chart perhaps hints it might do?
Well, I think that's right. Financial markets do tend to repeat themselves. You know, history does often repeat, and I think we should look at what's happened when we're trying to think about what happens today. Now, inflation has been falling. Price pressures are clearly easing. We've seen monetary policy start to tighten, and the effect of that is coming through into the economy. But this chart really shows us that maybe we should treat that with caution. Inflation does tend to come in waves. And I think that makes sense, because inflation tends to cause problems in the economy, problems for people, and that's, of course, what we're seeing at the moment. And governments naturally then try to solve those problems. And the way they do that, naturally, is to spend. I think we're in a political climate where there's not much appetite to increase taxation, and therefore, with a need to spend to solve some of these problems, presumably the only way is to issue debt. If central banks then come in and buy that, we could see money supply, which has fallen over the past couple of years as central banks have tightened rates, start to increase again. And maybe we will see a return of inflation in the more medium to long term.
Well, that brings us to financial conditions then. You've got a chart that also talks about the fact that real rates are back in positive territory and the consequences for that, if that becomes a theme longer term. As central banks talk about higher for longer. Talk to us about the potential implications as markets adjust to that new reality.
As you say, markets are adjusting to that new reality, and we have seen central banks now manage to get conditions a lot tighter. We know that monetary policy tends to act with a lag, usually 12 to 18 months. And while central banks have been tightening for some time, it's only around now that perhaps we're beginning to see the full effects of that coming through into the economy. Now, what that scary chart shows is real rates. So we've calculated that there as the Fed funds rate minus core PCE, so the Fed's favoured inflation measure. And if we look through history, what we tend to see is when that measure gets above around 3%, that tends to be a precursor to recessions. Financial conditions are then sufficiently tight to start slowing the economy. And if we look at the charts now, what we see is, based on the annualized data, the real rate having now reached 2%. But if we look at the 3-month PCE annualized, so more recent inflation dynamics, we see that actually we've got to above 3%, so a very scary chart for financial conditions.
Scary, but I suppose some people might argue it means the Fed could do some cutting if the horror show did transpire. Thank you so much, Andrew. Thanks for bringing us your suitably scary charts for today of all days. Andrew Eve, investment specialist at M&G Investments. Let's get to some of the other top red stories on the Bloomberg terminal this morning. Bloomberg has learned Saudi Arabia's military has gone into a state of high alert following deadly clashes with Yemeni, Iran-backed Houthi rebels. 4 Saudi soldiers died in the fight in the mountainous southwestern Jazan province on the border with Yemen. The latest incident took place as the Israel-Hamas conflict raises tension across the region. Houthi rebels also tried to fire a missile over Saudi Arabia toward Israel. General Motors has reached a tentative deal with the United Auto Workers Union, ending the 6-week strike that upended U.S. car production. The terms must still be approved by workers, but are broadly similar to agreements with Ford and Stellantis. The deal includes a 25% hourly pay rise, plus cost of living allowances, in an agreement that stretches into 2028. X, the platform formerly known as Twitter, is worth less than half what Elon Musk paid for it a year ago. Bloomberg has learned that restricted stock units awarded to employees value the company at $19 billion. Elon Musk bought Twitter a year ago for $44 billion.
Okay, coming up, the BOJ offers a small tweak to its yield curve control, pushing the yen higher against the dollar, lower against the dollar. Actually, in fact, the yen is currently at 150. It's down 0.8%, the Japanese yen. The Japanese yen is under pressure on disappointment for some investors that there wasn't more concrete action in terms of reworking yield curve control. We'll discuss what that means then for the FX markets going forward. That is next. This is Bloomberg.
There's much oil to be found in the lower 48 at this point, or even in, let's say, Alaska as well, or mostly we know where all the oil is, and there's no more big Permian Basin kind of deposits anywhere?
People have said that over time, and then we've always been surprised. And so the U.S. has been explored more than any other place in the world. I think the industry has a good idea, but technology allows you sometimes to recover things that you haven't been able to before. That's the story of shale. The other one that continues to be a positive story is deepwater Gulf of Mexico, where we'll go out and drill in a mile or more of water depth and then go down several more miles and find large fields. And the Gulf of Mexico is still relatively underexplored compared to the onshore. So I think there's still room for more discoveries.
Welcome back. Happy Tuesday. 53 minutes into your European trading day. You're seeing gains still being held across the European space. 0.5% is the upside coming through from the benchmark stock 600. And in fact, the S&P E-minis in the US have now turned into a positive territory as well, gaining 0.1%. Let's get back to what is happening, though, on the macro side, particularly with these central banks, with a lens on the Bank of Japan. Ven Ram joining us from our MLive team. Ven, what is your assessment then of the BOJ's decision today and the commentary from Ueda and what it means for the yen as we look at pressure coming through for that currency, currently trading at what, 150.38, 150, down 0.8%. We are on yen intervention watch.
Absolutely, Tom. It looks like a scary Halloween for yen, but I don't think it's quite going to be so. Why do I say that? Because, you know, the BOJ took some necessary, important, significant, but not sufficient steps for the yen to rally yet. So they, for all practical purposes, they've done away with curve control now because they're saying that they're now going to use the 10-year yield only as a reference point. So that is a precursor to where they need to be, which is to do away with negative rates. They are not there yet, but they have raised, another good point from today's meeting was that they've raised the inflation forecast to 2.8% for next year, from 1.9%. That's a very significant step because without an upward revision in inflation, they're not going to abandon negative rates. So all the steps are in place for them to abandon curve control next year. So I do think that there is an asymmetric risk-reward profile for the yen.
Yeah, you seem you can make this sound like a big deal, what we heard from the BOJ today, or not so much of a big deal, depending on what you're looking for the future, for the BOJ. I mean, what's your working assumption now on where rates go to then on JGBs, then? From what we've heard, we don't have a cap of 1, but we have a reference point of 1. Does that mean, and we don't go to 1.5 or 2, according to Ueda. So what do we expect to just be around 1.25? Is that where the new sort of cap for the 10-year is?
I would think so, Anna, because Ueda said that 1% should be doable, but I don't think it's going to be capped around there, especially if you look at long-dated treasury rates, they're surging, and there is no indication that we are done with the 5% level yet. So if long-end treasury rates continue surging, I think that the long-end JGB yields will also rise in tow. So I don't think 1% is the line in the sand. I think it has the potential to go much higher from these levels.
Okay, 1% is not the line in the sand. Ven Ram with the analysis on that BOJ decision from our Markets Live team. Thank you, Ven. Have a suitably scary Halloween. Remember, you can get up-to-date analysis and insight from Ven and the rest of the team. Just go to MLIV. Go on your terminal. We have a line crossing right now on the yen, weakening to 160 per the euro for the first time since August of 2008. Against the US dollar, 150, down 0.9%, but weakening to 160 per the single currency. Plenty more coming up. S&P E-minis in positive territory. Stay with us. This is Bloomberg.
I think this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in?
I'm in.
I'm in. We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
This is Bloomberg.
Good morning from our world headquarters in New York. I'm Manus Cranny.
And from our studios in London, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Markets whipsaw as the BOJ adds flexibility to its yield curve control program. Governor Ueda says he doesn't see yields significantly beyond 1%. Israel's Prime Minister Benjamin Netanyahu rules out a ceasefire with Hamas and dismisses calls to resign.
Calls for a ceasefire are calls for Israel to surrender to Hamas, to surrender to terrorism, to surrender to barbarism. That will not happen.
And a spooky month for stocks comes to an end as the earnings season ramps up ahead of the Fed's decision tomorrow. The S&P 500 rebounds from a near technical correction. Good morning. The Bank of Japan is loosening its grip. The last time it did this was on the 28th of July. Are we seeing as pronounced moves as we did then? Yields are rising on the JGBs this morning. Ueda says they will react nimbly. What does that mean? If you no longer have a hard cap at 1% and you are prepared to act nimbly, where will the market test you? Ueda doesn't see yields rising significantly beyond 1%. What exactly does that mean? Keep an eye on euro yen. You've broken 160 for the first time since 2008. You've had a near quadrupling of rates in Japan in the space of a year. Dollar yen, this is the dollar moving higher, the yen moving lower. Again, markets will test the boundaries and the bandwidth of what nimbly really means from the Treasury. No longer having a hard cap on the yields really is going to be through the prism of FX that you're going to see more pressure. So you are just seeing this biggest drop in 2 months as that grip is perhaps lessened a little bit by the Bank of Japan. 10-year government bond yields, it's interesting how the narrative in terms of the Treasury refunding has moved. Let's see what the state of play is in terms of issuance tomorrow. We've seen slightly less borrowing than perhaps the market had anticipated. But wow, Danny, it's a question of whether it's revolution or evolution at the Bank of Japan. Good morning.
Good morning, Manus. I mean, those moves in the FX market are remarkable, but as those moves have been happening over the past 15 minutes, relief is coming to this equity market. Now, I'm not too sure what's driving this, Manus, but just 30 minutes ago, we were negative across the U.S. futures. Now we've turned around. S&P 500 futures on the highs of the morning, up 0.1%. NASDAQ futures, which were decisively lower, are now little changed. We did fight back from the correction yesterday. The best day for U.S. stocks in 2 months. We did have a lot of analysts, though, decide to downgrade their year-end targets, OPCO being one of them. John Stolfus over there, your Denny's firm, also downgrading. So yesterday being a dead cat bounce on the eve of Halloween maybe is quite fitting. But again, sentiment seems to be shifting very quickly this morning as we head into the more liquid hours of the pre-market trade. European stocks, those are on the front foot too, Manus, up nearly 0.7% for Europe, despite BP earnings massively disappointing. Those shares have fallen as much as 4% today. It was their gas trading that missed. But Manus, we got to go back to the BOJ. The story of today, I think I've got that euro-yen chart again, just because these moves are remarkable. If you thought the release was dovish, the presser was certainly dovish compared to what we thought it would be based on the Nikkei yesterday. Ueda saying that he didn't think yields would go above 1%, that they'll still buy below 1%. Is this, as Kit Jukes puts it, Manus, that they haven't really changed anything but given themselves more flexibility? Is it them trying to have their cake and eat it too?
Well, this raises the game, doesn't it? Next year, they're saying inflation will be 2.8%, up from 1.9% this year. So what they're doing is they're setting the stage for perhaps something much bigger to come. It's interesting, we saw some bigger moves at the end of July when we saw the previous move than what we're seeing this morning. One standard deviation move. Yes, I find the one standard deviation move in dollar yen, not euro yen. I know Tom and John and Lisa will be dealing with the pros a little bit later on. That's the move they look at. Let's dig a bit deeper into the Bank of Japan, Danny, shall we? They've loosened the grip around the government bond yields, remaining the last of its peers to cling to negative interest rates. Governor Ueda spoke after the decision.
The Bank of Japan will not set strict upper limits or lower limits on long-term interest rates. Under our adjustment operations, we don't see yields rising significantly beyond 1%, even if upward pressure is placed on long-term interest rates.
Let's get to Mark Dowding, CIO at RBC Blue Bay Asset Management. They will move nimbly. He does not see rates pushing much above 1%. Is that hope, an aspiration, or will the market challenge it? How quickly do we break through 1%? How much more momentum is there in dollar yen? Good morning.
Good morning. So I think on JGBs, we are going to see yields continuing to push higher. I think the market will look to take on the 1% level and look to ultimately test where the BOJ is prepared to step in and intervene. But I think you have to remember that the reason that we're seeing this move up in yields is the fact that Japan is seeing inflation running above target. We're seeing 4% in terms of core inflation in Japan just now. And it seems that on an ongoing basis, the Japanese BOJ inflation targets are being rewritten as they were today, quite substantively. And so the direction of travel seems to be clear. The question is how quickly are we going to be testing those levels? And indeed, Mark, what is going to be
we have a BOJ and Ueda, if I can just jump in here, who has said they are happy to buy under 1%. So to kind of get back to Manus's question, I mean, how much higher can 1% do you think yields will really get? Again, if you have the governor himself saying that they will buy before it gets to 1%.
Yeah, well, I would suggest that if you're looking at yields getting to 110, for example, then ultimately you're looking at a point where Ueda is losing credibility. So there will be a level at which they will want to draw some sort of a line in the sand. I get a bit of a sense from Ueda and the Bank of Japan that they're hoping that the US Treasury market can bail them out. Obviously, part of the problem that they've had over the course of the last month or so has been the move up in long-term US yields has actually been putting pressure on the BOJ to act more swiftly than maybe it wants to. I think the reality here is, were we to see another leg up in Treasury yields, then I think that the BOJ would once again find itself in a very uncomfortable position. And if it is being forced to intervene to buy more bonds, effectively you're delivering more dovish monetary policy. This is going to undermine the yen, and you can see scenarios where sort of dollar yen is heading towards 160, and investors essentially concluding that BOJ policy is a model and that Ueda is making a policy mistake.
So there you go, Danny. You finally got the call of 160. So Mark, let's just, I mean, Danny and I are just talking to one another here. It sounds like this is pinning all their hopes, Danny's saying. What Danny, finish the sentence. They're pinning, Bank of Japan, pinning their hopes on a global bond market.
Yeah. Mark, what I'm hearing from you is that it sounds like they're pinning their hopes on no more global bond market sell-offs, which seems like a mistake.
I I would say so. I mean, it feels like all year the BOJ has had this view that actually the US economy will slow down, and they've been trying to make policy in Japan based on what they think about the US economy. And they haven't spent enough time actually focusing on the domestic fundamentals. Inflation in Japan has moved materially and continues to move materially, and it will actually accelerate again in all likelihood at the start of the new year. So I feel that BOJ needs to be looking closer at home.
Well, if you look at the ramifications, I mean, Mohamed El-Arian and a number of other people have talked about the pillars of stability within the bond market being removed. That's the US bond market being removed. Here we are. One of the pillars of stability has been the fact that you have this ongoing yield differential between Japan and the United States of America. That has, to a certain extent, been partially removed. You're looking at Aussie rates spiking higher, UK rates spiking higher. What is the vacuum flow from this change in Japan? Can that momentum build? Will there be further repercussions globally? Actually, if we look at it the other way around.
Yeah, so I do think that if we saw a very rapid move up in JGB yields, then this clearly would have global ramifications. But I would emphasise the fact is that we've seen an enormous move up in Treasury yields, an enormous move up in bond yields at a time where JGB yields have been relatively stable. And so saying that another 20 basis points move in JGBs as that pillar is eroded will translate into a move which is 2x or 3x of that in global markets. It may be a simplistic way of actually looking at things. The honest truth is that actually these markets have not been particularly correlated, and it's quite conceivable we could see markets going in different opposing directions next year.
You know what this is all leading to, Manus?
Trick or
It's
treat.
the Halloween spooktacular Halloween. I think that's what Mark said in his note to us. Is that right, Manus?
I mean, I got to hand it to Dowdy. You know, you managed to get it in there. You're going to have me down in Greenwich Village tonight, all dressed up and spooked up. But you talk about heightened volatility. Where the marginal factors, and I'm fascinated to know here, the marginal factors can have a dramatic impact on asset prices. And in that respect, we're light, but we suspect there will be opportune moments or better valuation points for you to go in. How light on risk are you, and where do you want to see the opportunity to dive in? Is it a break of US Treasuries at 5%? What is it that you see as an opportunity between now and Christmas?
So I think that there are a number of sort of troubling things that are going on in the world right now, and it feels like to us there's a bit of a sense of complacency in markets. If you look at equities, for example, you look at the multiples we're trading at, notwithstanding the move up in long-term discount rates on future cash flows, notwithstanding the fact that we've got issues in the Middle East and everything like that, we wouldn't be surprised to see investor sentiment tested at some point and a deeper correction. So were we to see the S&P trade down to 4,000 or below, were we to see credit spreads move wider, we'd like to be in a position where we can be buyers on any weakness. But what we're really cautioning against is complacency that we see in certain parts of the market. And from our point of view, it's actually been quite a tough year for a lot of investors. And when you have sort of a tough period like this, often you try and look for what the consensus trades are, because often markets will go towards the pain trade. And so you ask yourself what the pain trade really is.
Wait, Mark, sorry, we literally just have 30 seconds, but can you just put a bow on it? What is the pain trade?
So I think the pain trade here would be for yields to continue to rise and for stocks to continue to fall. I think that is the pain trade for now. But if you do see that moment of capitulation, that's probably the one that you're really looking for as a buying opportunity.
All right, capitulation watch. Mark, you're going to have to join us when it happens. Honestly, before it happens, just come back and join us maybe on a less spooky day. Mark Dowding there of Blue Bay Asset Management. Thanks for your time. All right, let's get you some other top stories that are trending on the terminal this morning. And we're back to Halloween. It's Scary Fast event on the eve of Halloween. That's not me saying that. That is what Apple called their new rollout of a new iMac, MacBook Pros, and the third generation of its in-house Mac processor line. The new chip lineup boosts performance and graphics. The company's homegrown semiconductor business, known as Apple Silicon, has become a prized asset.
X, the platform formerly known as Twitter, is worth less than half of what Elon Musk paid for it a year ago. Bloomberg has learned that restricted stock units awarded to employees value the company at $19 billion. A year ago, Musk bought Twitter for $44 billion, Danny.
And shares of Stellantis are rising after the car maker reported third quarter revenue that beat estimates. It confirmed its full year guidance in an update that analysts called strong. But Stellantis said prolonged strikes that curbed output at its North American facilities could cost the Jeep maker around $3.2 billion in revenue.
Coming up on the show, we speak to Madison Fowler of JP Morgan Private Bank to discuss the attractiveness of these opportunities for long-term investors. And Netanyahu rules out a ceasefire as Israel stepped up its ground operations in Gaza. We're live to Tel Aviv on Bloomberg.
That's me, Max. What's up? How are you? I have been writing about Wall Street for almost 15 years. And what that means is I write about feuds and rage and rises and falls and comebacks. And every now and then, I also write about a couple of villains. Thank you so much. And now, I am about to do something new and very, very scary. We are making a show, and it's based on Bloomberg Businessweek magazine. So what is this show about? It's a show about money, power, culture, pop business. We're gonna ask complicated and profound people about their ideas, their careers, their lives, their risks, their failures, their imagination.
It's so incredibly liberating not to care what other people think.
I was giving my tools to other communities. I wanted to bring those tools home.
Tune in. Please, really actually tune in. I desperately need an audience.
Season is here.
Tons going on, lots of earnings.
Beat wherever you look.
Bloomberg breaks the numbers first.
It's a tale of two earnings. Results from Goldman Sachs, Bank of America, and Morgan Stanley.
Netflix is out, guys.
With exclusive expert analysis.
Recovery is underway.
They crushed it. It was one of their best quarters ever.
This is a story all about pricing power.
We're going to make more money. We're going to make more money. And we're going to make more money. We're making bank. And I think that is what we can take away.
Bloomberg Television and Radio. Context changes everything.
Intend to have resign is Hamas. We're going to resign them to the dustbin of history. That's my goal, that's my responsibility, and that's what I'm leading the country to do.
That was the Israeli Prime Minister Benjamin Netanyahu dismissing the calls for him to resign and ruling out a ceasefire with Hamas. Let's get to Tel Aviv. Oliver Crook is on the ground. Oliver, fairly defiant Netanyahu. The latest on the operation, ground operations. Good morning.
That's right, Manus. As things intensify in the ground operation, we really have to pay closer and closer attention to those daily briefings we get from the Israeli Defense Forces. And so we've been watching that this morning. What we understand is that they have expanded yet further their operation on the ground in Gaza. They say they're going to continue to raid the areas. They are not giving a huge amount of detail on the mechanics, but they say that they're continuing to do that and that they're going to focus their activity really on the north. This is why they'd asked so many people to evacuate. They say 800,000 people have left the area, which still leaves quite a few, but they say that that is a positive development. That as we have more than 8,000 dead in Gaza, according to the health authorities there. The other few things that we're watching about are aid. The Israelis have said that aid will increase substantially this week, either today or tomorrow, potentially getting to that 100 trucks a day, which is what the UN and other aid agencies are necessary to get any kind of substantial relief in. Only 26 yesterday, so really until we see those cross. And then the question of hostages, they understand that they recovered one Israeli soldier. She is back home. She is in good condition and apparently had some intelligence for them in terms of the operations within Gaza.
Oliver, one thing that stuck out to all of us in the most recent 24 hours is the UN warning that in Syria it's the most dangerous it's been for a long time. What is happening in the region of a whole with this increase of unrest we've seen?
I mean, Danny, take your pick. I mean, Syria, you have Israel still striking in there, returning fire from operations that are happening within there. The U.S. has also targeted at least 2 targets within Syria, so that's one of the points. But another story out overnight from Bloomberg reporting something that actually happened last week, but that Saudi forces are on high alert after there was some fighting in the southwest of Saudi Arabia with Houthi rebels that killed 4 Saudi soldiers. So this is all, these are many of the flashpoints. You still have fighting going on in Lebanon. And of course, something that we need to watch also very closely is the West Bank. From Sunday to Monday, there were 6 Palestinians killed by Israeli forces. This is all part of the mix in terms of where the sparks could come in the next level of this war.
Yeah, and there's a number of warnings from the British government in terms of traveling to some of the countries in the Middle East. But that high alert for Saudi is particularly prescient. Netanyahu, in terms of the other issues that he addressed last night, his political future, he was very firm on that. What else stood out for you?
Yeah, so he was really a prime minister, it felt, on the defensive. It was a press conference that he gave in English. There were a lot of foreign journalists who managed to put questions forward, and defensive on 2 fronts. On the first front, which is basically Israel's actions in Gaza, he was really trying to send the message that he has throughout this, that there's a difference between the way that Hamas attacked Israel and the way that Israel is, though killing civilians, doing so as sort of incidentally. This is something, again, as you have 8,000 people dead, that may not be resounding terribly with the full global audience. But the second front that he is defensive on, he was asked last night by a journalist, you are losing confidence of the Israeli people. Will you resign? Will you step down? He said, no, absolutely not. The only thing I want to resign, as we heard him say earlier, is Hamas to the dustbin of history. But really, this is the question for many of us and for many people who are watching Netanyahu as the pressure rises, particularly after those posts over the weekend where he was really blaming the Israeli defense system, which were really taken very poorly in Israel.
Oliver, it's been almost a week, not quite, but almost a week that the U.S. has actually had a Speaker of the House with Johnson in charge. Where do we stand on American aid to Israel?
So really, this is going to complicate a little bit, as it seems. What Biden had tried to do, as we recall, after he came to Israel, he gave that sort of Oval Office address, and he said that we need to deal with a lot of different crises at once, and he rolled them all together to this request in Congress for more than $100 billion. Now, what the GOP is wanting to do with its new leadership is to disentangle all of these parts because they don't want to support, in the same hand, Ukraine and Israel. So the GOP is willing to put forward this bill for $14.3 billion for Israel, which is key funding for Israel and is very closely watched here. Okay. But again, it makes it more complicated now because it completely changes the dynamic of what the Biden administration was trying to get through.
Oliver, thank you very much. Oliver Cook in Tel Aviv with the very latest headlines. Right here on Bloomberg from New York, London, and Tel Aviv.
This will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in?
I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
Good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to The Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg. The top names at the Fed are on Bloomberg.
The economy is handling much higher rates, at least for now, without difficulty. So notionally, that might tell you that the neutral rate has risen, or it may just tell you that we haven't had rates high enough for long enough.
The bond market has tightened quite considerably. If financial conditions are sufficiently tight, our work is not necessary because we don't need to boost them more.
Nobody covers the Fed like Bloomberg. Context changes everything.
This is Bloomberg Brief with Danny Berger in London, Manus Cranny in New York. Now to a story that caught our eye and is one of the most read stories on the terminal this morning. Manus, Morgan Stanley's decision to award its new CEO, Ted Pick, and two of the top competitors for the CEO role $20 million worth of bonuses each. It started to raise some questions over governance for Wells Fargo analyst Mike Mayo. Mayo saying that it shows the bank is, quote, paying top execs to stay, which raises a question about whether, Manus, they are staying due to comp more than culture.
Well, if somebody offered me $20 million, I tell you, I'd go to pretty much any part of the world. Work as a reporter on the side of the street, pretty much. But
same probably.
If you go back to what Mayo wrote just a couple of days ago, if this is managed well, in other words, the retention, if this is managed well, the potential is to become a textbook transition, a telegraph transition with a known executive and top managers staying on. Well, wouldn't you stay on if somebody gave you $20 million? I mean, your scruples about not getting the top job, I suppose it's ego versus dollars, isn't it?
I mean, give me 20 million, Manus, and I will conform to whatever culture at whatever firm you want me to. Maybe some exceptions, but not many. But you're right. Alison Williams of Bloomberg Intelligence says the same thing. One of the key risks is whether Saperstein and Simkowitz stay on. Is 20 million enough to get them to stay on, Manus?
Well, keeping them is part of the succession story. There you go. You've just told the bosses now that you'll go anywhere for money. That is where you are, but you're going to come and stay. You're going to come to New York with me, aren't you?
Yeah.
Tell the truth.
Yeah, absolutely. Good. Absolutely, and I hope a nice 20 million is waiting for me on the way out, Manus.
More on the markets in a moment.
So many people say the only way to really deal with climate change is kind of eliminate oil and gas and then have more clean energy. Is it realistic to eliminate oil and gas in the foreseeable future?
You actually have to at least mitigate it. I think you have to bring a lot of it down and replace a lot of it, but you also have to, you can also have a huge impact by trying to do things like carbon capture and so forth, right, and around it. And it's going to take both approaches. Even today, greater than 80+% of the way the world operates around energy right now is still fossil fuels, you know, when you kind of look at it. And probably what's more striking is the fact that the demand for it is going up every year.
Things like solar or wind, it's nice and environmentally friendly, but really it's not going to be produce enough energy to really replace oil and gas in my lifetime, I assume, right?
Well, not by itself. So let me just say, solar and wind are critical components. You need, this is going to be sort of a collective effort with a lot of different technologies that are each going to come in and take their piece. What we do at Breakthrough, we look at technologies that could produce half a gigaton, remove half a gigaton of carbon a year. And the way to think about that number is we have to remove, say, 100 half a gigatons, you know, a year in terms of what we have to replace.
Slice through the noise.
Forget the noise, ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal.
Now, more to the point.
What is the lesson or the observation?
When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers Jobs Day like Bloomberg.
Welcome back to Bloomberg Brief. I'm Manus Cranny in New York.
And I'm Danny Berger in London. Here's what you need to know. Markets whipsaw as the BOJ adds flexibility to its yield curve control program. Governor Ueda says he doesn't see yields rising significantly beyond 1%. Israel's Prime Minister Benjamin Netanyahu rules out a ceasefire with Hamas and dismisses calls to resign over security failures in the October 7th attack. And a spooky month for stocks comes to an end. Earnings season ramps up ahead of the Fed's decision tomorrow. The S&P 500 rebounded from near technical correction levels. But let me tell you, we are getting whipsawed in this futures session today. I started out the show 30 minutes ago saying, wow, a bid is in for this equity market. It's pretty much disappeared. For U.S. futures, we are flat for the S&P. Yes, it clawed its way out of a correction yesterday, but it's really failing to hold on to that momentum. Tech stocks getting hit especially hard today. NASDAQ futures down about 0.25%. It could be this Wall Street Journal story on NVIDIA missing out on about $5 billion worth of sales to China due to AI curbs. It could be some of the weak China data we have. It could be just this nervousness in this market we have over a, shall we say, confusing BOJ decision. European equities, those are up about 0.4%. Some poor earnings from BP. Those are making the shares fall today. Some weakness with their gas and tradings business. But again, man, it's the only way you can really characterize this morning's market is confusion and skittishness.
Yeah, well, you're not exactly the voice of joy in that market, are you? I mean, if you could find a good news story, give it to Danny. She just broke the bid in equity markets. One thing for sure is that the Japanese are loosening their grip, a vice-like grip around yield curve control. What does it mean? They will move nimbly. We've just had Mark Dowding saying the test for this market is to take it to 1%. So they are going to move nimbly. Yield curve control, no longer a hard cap at 1%. They will move to adjust it. They will move nimbly. Dowding from Blue Bay says not only will they test the 1%, but if it gets to 1.1%, Ueda will have lost control. That takes us to dollar yen. What happens next? Perhaps the bigger volatility trade and the bigger capacity to move is in the FX. It's an unbridled market. It's a less dirty market, so to speak. Yes, there's intervention in it. It could get to 160. Martin Malone at Oral says this is a pretty much blowing off of yield curve control. Of course, he was with us and he said dollar yen gets to 200. Dowding says 160 is eminently possible on dollar yen. Ueda says that they will patiently continue with easing. For now, the markets are not convinced dollar yen is testing the metal. Let's see where the Ministry of Finance becomes so urged. Keep an eye on U.S. Treasuries because, of course, we got the news yesterday that they've cut their borrowing target to $776 billion. That is still a record. That is still a record. And you're on course for a $2 trillion deficit by 2025. So the heat has not gone completely from this U.S. Treasury market, which the Japanese are hoping will do the dirty work for them and cap yields. Danny, good morning.
Good morning, Manus. Yeah, that's what Mark Dowding from Blue Bay said, right? That they're kind of pinning their hopes on not having a global bond market sell-off. That's kind of a scary prospect, given what this bond market is doing. And he gave us some potential levels for Japanese assets should something like that happen.
Yeah, as I said, 160 on dollar yen and 110 on JGBs would be the real point of contention with UADA.
Yeah, but if it goes above 1% by too much, Mark Dowding says that threatens really the reputation and credibility of UADA. And Manus, to that point, I know you've just showed this. Let's just bring it up so everybody can see it, what the board looks like for Japanese assets. I'm not going to spend too much time on this because you just did such a good job walking us through it. There you go, 150. Nikkei stocks are rallying, but again, that 10-year yield up about 5.5 basis points. But what does this mean for the global world of bonds? Joining us now is Madison Fowler, global investment strategist at JP Morgan Private Bank. Madison, again, just approach this from a global lens. Does today's BOJ decision, more flexibility, maybe more confusion for the markets, does it change anything for your treasuries?
Sure. Thank you for having me. I think there's a little bit of that for sure. I think to some extent you're seeing one of those final remaining anchor points for global bond yields start to come loose. We saw some of that really start to happen over the summer, which I think contributed to that rise in term premium that we saw in treasuries, certainly contributing to that surge higher. But I do think that needs to be taken in tandem with how high treasury yields already are. And certainly one thing that policymakers and Fed Chair Powell has really made sure to, I think, telegraph is that with rates at such high levels, that ultimately goes to, I think, add to the restrictiveness of rates and that tightening in financial conditions. And so I do think that you have to kind of weigh those two balances together.
Madison, good to see you this morning. You say we're in a pocket of discomfort. Will there be more of an uncomfortable, bumpy ride in the bond market? In other words, testing and blowing through the 5% level, perhaps relative to the equity market, which has already had a technical correction in SPUs and a correction in NASDAQ?
Sure. I think it's very possible we see some further spikes in bond yields from here. We have a flurry of data coming our way over the course of this week. We have the Treasury refunding announcement coming on Wednesday to give us a sense for how the Treasury will be looking at the maturity of that debt. We also have the Federal Reserve meeting, how they're signaling higher for longer. And we have a slew of jobs market data. So I think that there certainly are still some points that could signal to us, do we have, stronger growth? What does term premium look like? So I do think that you could see some spikes from here. But again, to bring it back to the fact that higher bond yields do act to, ultimately slow economic momentum, we do think that the path lower for interest rates is ultimately lower over the course of the next 12 months.
Can you trade that yet? I totally get the idea that on a long-term horizon this makes sense, but it is such a skittish market. It's a difficult bond market. Even equities up more than 1% one day, falling into a correction the next day. Is it too soon to position yourself that way, or do we need to wait till next year to see if that's actually how it plays out?
I think we can take it in steps. And I think one of the first things to do is to step out of cash. And so we think that cash ultimately it's worked over the course of the last year as central banks hiked quite aggressively. But now we're confronting reinvestment risk as central banks go on hold, start to talk about, when those cuts might eventually come into play. And so I do think taking that first step out is important. When it comes to fixed income, I think you can take a little bit more of a barbell approach. You can take a little bit of credit and duration risk, so staying shorter duration for maybe one pocket of your fixed income exposure. But then at the same time, we know that after the final Fed rate hike, over the last 7 hiking cycles, 10-year Treasury yields tend to fall 100 basis points over the course of the next year. So some longer duration fixed income also probably makes sense.
I think the difficulty is whether the data, if the Fed is truly data dependent, they may have no alternative but to go for another hike. We're looking around some of the other big house analyst notes, and some people are saying projected earnings forward into 2024 a little bit too rich, a little bit unrealistic, and absent of real rate cuts, it's just too hopeful. Do you think valuations are too rich? Do you think forward PEs are just a little bit too rich looking into 2024?
I think we've seen a lot of correction already in valuations. When we look at S&P 500 forward PE ratios, you are looking, pretty much back in line with long-term averages. So I think for the path for valuations, I think really relies on some stability in bond yields. I think it's also important to, think about why bond yields are rising. To an extent, if that's due to better growth, I think that's something that equity markets can handle. But I think what's really more important for us is that earnings backdrop. You're seeing some skittishness around this earnings season, I think, as management starts to talk about, what future quarters might look like. But I really wouldn't miss the forest for the trees. This actually looks to be the first quarter of earnings growth after 3 straight quarters of contraction. And I think as the market, moves past these catalysts and gets more clarity that the Fed is indeed done hiking, I think that allows for earnings growth to power through and for stock markets to rally forward. But again, that's not to say there won't be some volatility along the way.
I mean, to that point, investors have just been punishing any company that slightly misses. We saw that in big tech. What do you just make of the sentiment shift we've seen this earnings season?
Yeah, I think it's been really interesting. To that point, of the companies that have reported, 60% of them have had a negative price reaction. And I think that has to do less with the earnings results themselves, but again, more so what management has been, forecasting for future quarters. Are they seeing, I think, more macro headwinds, and what does that mean on a go-forward basis? But again, I would just telegraph that these are quite solid reports, and I think once we move past this quarter, I think it's more of a transition quarter. I think it starts to look more promising.
Madison, let's just square off. We've had services in China come back less than we estimated, manufacturing solidly in contraction. Again, what are your hopes for China, and how relevant, does China still have the same capacity to shift your risk sentiment as it did in historical times, let's say over the past 5 years?
Sure. So I think, when it comes to China, it's certainly been a disappointing path over the course of the last year when it comes to that economic reopening story. And so I think, it probably continues to look a little bit more difficult until we have, further confirmation that policymakers are able to put a floor under the housing sector. But I do think that this cycle looks different than past ones that, we've seen with China. This economic recovery is not housing-led because policymakers are concerned with exacerbating existing debt issues, and so instead they're relying on that being led by the consumer. And then when I think we expand that out into the rest of the world, one thing that we do note is that sales exposure from China to the rest of the world is quite small. It's 1 to 2% in the U.S. It's higher in the Euro area, around 10%, which is I think why you're seeing more pressure on European markets relative to the U.S. But I think hesitate to overstate China's impact on the rest of the world when it comes to stock markets.
Okay, Madison, I think we're going to have to leave it there. Thank you so much for joining us this morning. That is Madison Fowler of JP Morgan Private Bank. All right, let's get a quick check on your markets as we head to the break. S&P 500 futures attempting to put in some gains, and you got it up 0.1%. Dollar little changed as the yen dives versus the euro and the dollar. 10-year yields, those coming in by about 6 basis points as crude climbs to near $83 a barrel. This is Bloomberg.
has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
This story did come around as something that's a bit different. There is a dark side to it.
It's hard to even talk to people about these chemicals and tell them, look, there's a chemical that's in you that's not found anywhere in nature.
We've all been used as guinea pigs for the last 70 to 80 years. We weren't told we were being exposed, but they did it anyway.
This right here is the shadow fleet. To actually see clandestine behaviour was really surprising. That makes you think, well, what else is going on?
A lot of people let Agnes down. What she was told is exactly what happened to her.
It took the lid off a much bigger problem. I think that's probably the most shocking part of this whole thing.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
This is Bloomberg Brief. I'm Danny Berger in London, alongside Manus Cranny in New York. Manus, we've had a whole lot of earnings out of Europe. Worth just going through some of them. BP falling this morning. Yes, their third quarter profit rebounded, but the weakness was in their gas trading.
Are you Budweiser or Stella Artois? That's the question you need to ask yourself for AB InBev. Here in the US, of course, Bud Light fell 13.5% amid the pushback on the marketing campaign with transgender influencer Danny. So the stock will be one to watch.
I drink neither of those things. Anyway, BASF, sluggish German economy, high energy costs weighed on earnings, but still able to climb about 4% this morning.
And then Stellantis absorbing a $3 billion strike impact with higher revenues. So those are the stocks to watch on the board today.
All right, let's get more into this earnings season. Tim Craighead of Bloomberg Intelligence joins us now. And Tim, every quarter publishes a great scorecard for earnings. Tim, what's the scorecard telling us? How do we judge this quarter so far?
Yeah, I tell you, it is a real mixed bag. And it's cliche-ish, but it's true. At this point, we've got about 45% of the European market cap having reported earnings, that does report earnings in a quarterly basis. And at this point, you think on the surface it's okay, 50% or so beat, 35% or so miss. But this is the worst record from that perspective that we've seen since the pandemic lows back in 2020. Quite typically, companies play that a little bit better. Within that context, you've got a real variety of reactions. You just talked about a miss with a positive reaction, a beat with a negative reaction. That's across the board this time. It's really a bit willy-nilly, to be less technical. I think two sectors to pay attention to from that vantage point. One is energy. Notwithstanding BP today, there have been some misses given the nature of where we're at with energy prices down from last year, but the stocks have reacted generally positive because energy prices are up from the lows of a few months ago. So take your pick. Financials are the real, I think, key point. Where we've ridden this wave of net interest margin expansion. If companies have come in and been okay, the stocks might react a little positive, but God forbid they miss, or there's a crack in that net interest margin story, the stocks have been punished. Our analysts have a negative focus idea on the European banks looking into next year because of that.
Yeah, and we saw some brutal punishing of stocks last week where their top line, especially in tech, where their top line profits were grand, but within the cloud business, for example, it was really aggressively pushed back. RBC said is the most pessimistic tone on post-earnings conference call. That's perhaps the most striking, which takes us back then to labour costs are rising. We have high interest rates. So what's the impact on margins and profitability? Have we any more light on that, Tim?
Yeah, it's really interesting, Manus. This has been the biggest concern that we've had coming into the earnings reporting period for some of those factors that you've discussed. In fact, on the surface, margins have been pretty resilient. Top line has missed a little bit. Margins have held up, which has actually, kept that earnings performance okay. However, if you dig into some of the details, we've got some concerns when it comes to, as you said, rising labor costs. With that, companies have really taken an aggressive stance on restructuring, which I think is part of the margin resilience story. We've had 17 companies in October announce layoffs of about 26,000 people. In the prior 3 quarters, it's been 19 companies per quarter with a little over 20,000 headcount reductions. So much more aggressive right now on trying to protect the margin.
Right. We also had some China data this morning, another weak set of data. This time it was factory orders. I know you and the team have done a lot of work on how much of the China weakness actually ends up filtering down to European earnings. What did you find in terms of that exposure?
Yeah, so going into earnings, we had done some analysis. There's 80 companies that have got substantive exposure across the Stock 600. It adds to about $450 billion in revenue. And these are big companies. It's over 30% of the market cap of the Stock 600. So it matters. What we're seeing right now, I'd say, is certainly skewed to the negative. We've seen the auto companies all have issues from the standpoint of competitive pressures. Pricing concerns. We've seen some of the luxury goods companies have softness in China. The reopening story just hasn't come through. That said, there's been some positive surprises as well. Atlas Copco has been good in the vacuum business, which feeds into semiconductors. You've got Hermes that's been better than, say, LVMH. Right. So go figure that one out. So I do think
that's because Danny's actually been buying her. That's actually because she's got the order in for the Birkin bag, and she sent me down to Dior, and she said, "Can you make sure you come back with the Dior Birkin stocks?" I said, "What kind of wages do you think they're paying me here with the rent?" But you've got a spooky treat. You've got a spooky treat for us, haven't you? Go on, show us your Halloween costume. I'm dying to know what you're going to wear. I'm still deciding for tonight.
I want to know how Tim has been able to see us this whole time without wearing his proper glasses. He's only just put them on. This is the true Tim Craighead, Manus.
It's the spooky brief. Never let it be said that I'm the mad person on this show. That's all I'm saying. For mental health reasons, there's other people. There's other people with bigger issues than me.
I should just say, because we have a radio listening audience too, I should just tell them Tim has pumpkin glasses on right now. They're probably very confused, only getting the audio version of this. Tim, thank you very much for joining us. Tim Craighead, Pumpkinhead? I don't know. Maybe we change it up for this Halloween season of Bloomberg Intelligence. It really is. All right. Coming up on the program, we're going to take a look at some of the market moving events to watch throughout your spooky day, Manus.
Danny, let's just check in on the bonds this morning. You've got 10-year government bond yields just coming down ever so slightly. And of course, we had Mark Dowding from Blue Bay saying the Japanese are hoping that another spike in the US bond market will do the job for them, capping yields at around 1%. Bulls drop a little bit lower. Of course, we had North Rhine-Westphalia yesterday taking the heat out of the bond market. But the Aussie rates rise quite significantly. Will the RBA have to go for another hike? That is the mood in the market. Good morning from New York and London on The Brief.
younger generations are more, of course, pay more attention to sustainability, and so they are looking at brands that are greener. But you have to make sure you're authentic because they hate greenwashing. But what is very important to remember is that none of them, whether they're young or not, will ever sacrifice product quality and efficacy to sustainability, which is why, part of the big transformation of our R&I, where there's this €1 billion we spend every year, most of it is spent on transforming our formulas from petrochemicals to biosourced ingredients and green sciences, but without losing the efficacy.
Your grandfather was a famous basketball player. In fact, he's in the Basketball Hall of Fame. Did you have any of his basketball genes?
In my family, David, you didn't do very well at the family barbecues if you couldn't play hoops.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Welcome back to Bloomberg Brief. Danny Berger in London, Manus Cranny in New York. Let's get you set up for your trading day with a look at what's ahead. So first up, we have a lot of European eco data coming throughout the day. We'll get Eurozone GDP and CPI at 6 a.m. Eastern time, so very shortly. We're also going to get ECB remarks from Governing Councils Maddie Smoller, Joachim Nagel, and Vice President Luigi Guindos. And finally, a check on, we're going to have a lot of earnings on deck. Caterpillar, Pfizer, JetBlue, Marathon, Petroleum, all open before the market. And Manus, we'll talk more about Japan in just a moment, but in a couple of minutes at 6 a.m. Eastern, we're also going to get Japan's Ministry of Finance. They'll release their data that will tell us whether or not they intervened in this FX market in the past few weeks.
So we've had one call. We've had two old buddies in this market, which is Mark Dowding at Blue Bay, talking about perhaps the market will punch through and test 160. You're probably going to see a bigger manifestation of testing the metal of the Bank of Japan and the Ministry of Finance in the FX market than you are in the JGB market. Martin Malone is still at oral. He's still banging that 200 to the yen drum. But perhaps the biggest thing of all is the euro yen breaking through levels that we haven't seen, breaking through, I think it's 160, and we saw that back in 2008. So the FX market is where it's going to get, I think, a lot friskier and more quickly rather than the bond market.
Yeah, it's this question, again, is the BOJ trying to have its cake and eat it too? I mean, I've said this, Kit Juke said this to us a couple weeks ago. I think I've said it maybe every day since then. But it is this question of, can they have the flexibility they want and not face this pressure on the yen? Can they have this flexibility and not have to spend a lot of money if there's a global bond market sell-off? Mark Dowding told us that the BOJ is probably pinning their hopes that you don't have pressure coming from the Treasury market.
Don't forget, they've already got 60%, I think, of the JGB market. If you go back onto July 28th, the currency moved by 0.7%. Sorry, we've moved this morning by 0.8%. On July 28th, when they last moved, dollar yen moved by over 1.2%. Quick snapshot of what we've got coming up. We've got the Pfizer CEO a little bit later on today. That's at 2:30 p.m. Eastern time. That is going to be a cracking interview to tune into. Albert Bourla.
Yeah, because we'll have Pfizer earnings, and we also will have Caterpillar earnings. Too long considered a bellwether for manufacturing and industrials. How will it hold up? That's it for Manus and me. Surveillance up ahead.
A cruise ship is much more than a flotilla of financials and numbers. Naftali Holt showed me around the Celebrity Beyond, Royal Caribbean's newest ship, rolling out not the red carpet, instead, the magic carpet, an example of investment that's yielding returns in several different ways.
Originally, actually, we designed it because we wanted to have a really nice platform for tendering, because sometimes we can't home port
So
destinations.
functional.
Exactly, value fractional. And then we looked at it and said, why don't we just make it a really cool feature spot where people can enjoy it beyond the functional space? And we created this bar. It went up and down.
Now, what does it take
How
to
about the Instagram? Can you think about that?
I can imagine.
Instagram moment with the sunset, having a drink with your friends or family. I mean, that's amazing.
So what does it take to do something like this? And I'm thinking cost, engineering, time.
Yeah, a lot of effort from a lot of people. So it starts from just the design and the conceptual aspect of it. Then we need to figure out a lot of technical factors, the weight, the wind, and so lots and lots of hours of really hard work. And every time we up the game, we see that customer willing to spend more.
This is Bloomberg.
If you look at the economic data today, it is so significantly consistent with a downturn.
Stocks are in a bit more of a wait-and-see mode.
It feels like anytime there's a part of the market that gets a little bit of leadership, it can't sustain it for that long.
The Fed is probably going to want to keep its options open to hike more.
The Fed is just well ahead of other central banks.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene on radio, on television. We're costume, we're treating, we're tricking. It's October, is it 31st today? Halloween. I'm going as yield curve control is what we're trying to do. Mrs. Keene said, oh, is that a diet? And I said, yes, that's a diet.
Is that how you sold it to her?
And what a choice. She wore black today. Great. I went with sort of a gray motif, but on how I think it's just inspired you want his toxic brew.
Oh, thank you. I appreciate it. I had to really dig deep into my soul to find the toxic brew. But I will say, if you're yield curve control, I think a little bit more ambiguity would be good, because honestly, I don't know what that means this morning after what we heard from the Bank of Japan.
John Farrow going is the next head of Chelsea football. We'll have to see who that is. Maybe it was Man United. I can't remember which team. Let's go to the business right now. Economics, finance, investment. And in the Western world, we're looking at one thing. They act in Japan. Lisa, let's start there with what the Japanese, and I'm making a joke about this. This is not funny.
Okay, what did they do? They basically created more ambiguity around what 1% as a band was. They increased their inflation forecast for this year, next year, and the year after. And then they put this out from Governor Ueda. Uncertainty is extremely high, no kidding. We decided that it's appropriate to increase flexibility so that long-term yields can be smoothly shaped according to different future scenarios. What does that mean?
It means they have to adapt to what's out there, and it's a busted theory. That's what we hear from everyone, and we'll be covering this a lot, of course, into the Fed meeting, which I believe is tomorrow. I'm working a 3-day work week this week, guys, so, cut me some chase. But there are headlines out moments ago. We're going to rip up the script here. We have to do that with Euro area third quarter GDP, and the word is there, contracts.
Yeah, well,
which is a big deal.
Basically, the idea is that Euro area third quarter GDP unexpectedly dipped 0.1%, contracted quarter over quarter versus the estimate of just basically being flat.
Consumer prices.
But that to me is more telling. Consumer prices coming in more than people previously expected. This is good news for Lagarde, for Christine Lagarde. 2.9% increase in consumer prices in October versus the estimate of 3.1%.
One of the themes we have here in the next 4 days, and of course the Fed meeting, and of course the importance of Apple's earnings, we'll touch on that as well. Lisa's buying all of the MacBooks for the fam this holiday season.
Actually, I did go to Apple Store yesterday, and I had to revamp some of the phones. And I have to tell you, I've been giving you grief
all year about your prognostications about how Apple, full faith in Apple. And then I went and I actually paid what you have to pay for all of these instruments and all of the different things that they sell you on top of it. And you're dropping big money. And there's a line out the door for everybody to drop big money. I mean, it's the Bank of Apple.
Right there with Bramo, folks. It's a threat to Mark Gurman's employment there with that careful Apple analysis.
Thank you, Tom.
Farrell just emailed in. He's not in Brazil. He made land. I saw he went through immigration.
Oh, good.
They
I'm
let him
so
back
glad.
into the country. But
From your cruise?
Yeah, it's like Miami. He's getting the feel. He may move to Florida, taxes.
Can you imagine?
And all that. Let's do a data check right now for you on television and radio. Green on the screen and more green on the screen as well. And the VIX under 20 to me is important, 19.35. And the yield front, 5.02%. Two-year, 10-year, 4.82. 30-year bond under 5%. Crisis over, 20 beeps on the 2s, 10s. And we won't do the real yield yet. It's giving me a nice number. Dollar. And we're going to go to yen here, which is very important. At the yen, rounded up, a 151 yen, weaker yen back 40 years. And euro yen, I don't want to slow the show down. I'm gasping here. We could trick or treat. It was too many baby Ruths. The euro yen, 161 on euro yen as well. This is serious. We're making jokes about it, folks, but this is really disarming to global finance.
I want to give you a sense of what some of the important indicators are going to be today. 8:30 a.m. we get U.S. Employment Cost Index for the third quarter. It's the drumbeat to what we get on Friday. Do we see that sort of disinflation of just wages, especially after what we saw with the UAW over the past couple of days? 9:30 a.m. Secretary of State Antony Blinken, Defense Secretary Lloyd Austin are testifying at a Senate Appropriations Committee trying to argue for more money. The split between Senate Republicans and House Republicans, key right now, especially with the new House Speaker. And we get 29 companies reporting earnings today. Before the bell, we hear from JetBlue, Caterpillar, Pfizer, the whole healthcare question about whether there was a bubble in healthcare during the pandemic, and now it's sort of a reckoning. But AMD after, speaking of what we've seen in the smartphone indicators that I just purchased yesterday.
Trying to give you smarter coverage on earnings as well, not only looking at earnings, but looking at revenue dynamics. We'll do that today, and of course with Apple November 2. Right now, he is back in Israel, in Tel Aviv. Oliver Crook joins us for a brief. It was really distressing to see the headlines overnight. Oliver, can I state this morning, Oliver, in New York, that there are battles in tunnels?
Well, Tom, it's a complicated question because a lot of what is happening now in the ground offensive, which we understand is expanding, that the Israelis are not really being very transparent about the mechanics of what is happening now. So what we've had to do very clearly and very closely watch what we're seeing from the IDF and the comments that they've made in the last few hours. And what they have said is that they're continuing to expand around northern Gaza, and so not just in one location, but a number of different locations. They say they have been killing dozens of fighters that are coming from tunnels, so you have to assume that that is going to be part of their game plan there. And they say that more than 800,000 people have fled the north. And remember, this is all part of the ground that they laid, really bisecting the area of Gaza and focusing most of their fighting in the north there. They've also updated their hostage figure. They say there are 240. They say they've also recovered one hostage, an Israeli female soldier who is in good health and good condition, and they said they were able to get some intelligence from. But again, as this rolls on, and again, it's a new dimension for there to be a new spark and a new impetus for more escalation.
Ali, Syria, Lebanon, Yemen, there are new fronts, although they aren't necessarily in extreme forms of fighting just yet. How do you sort of reconcile the idea of a non-escalation with fighting in these places?
Well, this is the question. And again, it's in Syria, for example, the Israelis have been striking. So too have the Americans. The Americans have struck at least 2 locations because they are coming under fire. So that is one place to look at. Lebanon, we've talked about a great deal. We've talked a little bit less about the West Bank, where we understand from Sunday to Monday, 6 Palestinians were killed by Israeli forces there in terms of skirmishes. But then a really important story out overnight from Bloomberg reporting about this skirmish in the southwest of Saudi Arabia with Yemen, with the Houthis, that killed 4 Saudi Arabian soldiers, and that now the military in Saudi Arabia is on high alert and apparently also intercepting missiles that are going over Saudi territory. So again, it's your pick of all these different points where you can see the sparks emanating from.
Well, the span of tension in the Eastern Mediterranean. Oliver Crook in Tel Aviv, thank you so much for our early morning brief here. Now to consider the finance and investment of where you are into the Fed meeting and into year-end. Russell Kosterich joins now, portfolio manager for BlackRock's global allocation fund. Russell, you're beginning to write up a year-end report, a year-end view. It's going to be 17 pages. What do you do after page 2? I'm fascinated how you construct a view forward to 2024.
Well, I hope it's not going to be 17 pages, Tom. No one's going to read that. Look, this has been an extraordinary year, and I think it's not just the fact that we've seen a remarkably resilient U.S. economy, which, by the way, we think is going to continue into 2024. It's been the move in rates, the market's resilience for the most part, with that move in rates, and I would say the continued success of a small group of companies that have really defined the U.S. market for much of 2023.
Russ, Bill Gross started in the mailroom at PIMCO a few years ago, the Pacific Investment Management Company, literally clipping coupons. Folks used to take a bond and scissors and clip the coupon and you get your interest payment. Are we clipping the coupon forward 12 months, forward 13 months, or are we total return?
I think it is part of the total return. I mean, this is an excellent question. When we think about what we've been doing in the fund, we bought a lot of bonds over the last few years. We bought a lot of credit back in 21 and 22 when spreads were wide. We've been holding that. And, again, it's not that I think right now you want to pile into any particular area, but opportunistically, whether you're looking at securitized, EM, the short end of the curve, there are opportunities. And exactly as you say, if you're thinking about building in a 6, 7, 8% yield into parts of the portfolio, well, that gets you part of the way to your goal. And that's something we've not been able to do really since before the financial crisis. It's a different way of thinking about the portfolio, let's say 5 years ago when you were getting nothing on the front end of the curve.
How much are you going into bonds in favor or in lieu of stocks, especially globally, Europe, other places where growth is a lot less certain?
Well, just to be clear, we are still a little bit underweight bonds. We're a little bit underweight duration. That's partly a function of the fact that there is a lot of uncertainty about the Fed, although we think that they're probably done. But the main concern, I think, on parts of the bond market, particularly the traditional part, is really about the premium you're getting, the term premium, to go out on the curve. And that is as much to do with the supply and changing demand dynamics as it does about inflation or the Fed. So I think you still want to be a little bit cautious on long duration bonds. On the equity side, we're pretty close to home now. We're close to our benchmark. I do think you've got an opportunity if events don't erupt in the Middle East for year-end rally. But right now, the byword we're using in every meeting is idiosyncratic risk. In other words, rather than focusing on taking a big equity bet, picking your spots, looking for the parts of the portfolio that align with long-term themes, rather than just saying, let's go out and buy lots of stocks.
You said something very interesting there, Russ, that this has more to do in the bond space with supply than it does about inflation dynamics or growth, at least in the U.S. Yesterday, we got a net borrowing estimate from the Treasury Department that was slightly lower than what people were previously expecting. Part of the reason why some people are saying you're seeing a bit of a bid into bonds today. You're seeing yields come in. How much is that the entirety of the story behind the yield move that we've seen in the U.S.?
I think there are a lot of dynamics going on. I don't think you can ever attribute to one factor, but I do think you're right to point it out. And it's an interesting, sort of story because 5 years ago, no one was paying attention to these releases. I shouldn't say no one, but it certainly wasn't moving markets. And I think, as you correctly point out, this is likely to move markets going forward because when you look at the move we've had, people are worried about how much of a premium do you need to own the long end of the curve, and that's still an open question.
Major topic at BlackRock with BlackRock's success. Is this a time for active management, Russ Kosterich, or do you shelter out in passive portfolios, index funds?
Look, there's always a role for passive, and there's a reason that has exploded as well as it has. But I do think this is an opportunity for active, and I'll go back to the fact that the portfolio is probably going to look different than it did in the post-GFC world. In that world, you could take really, 2 allocations, U.S. equities and U.S. ag. You could put them together. You get a remarkably good return for more than a decade. I think now you need to be more dynamic. You need to think about the role of carry. You need to think more about stock-specific risk.
Thanks for the brief. Russ Kosterich of BlackRock as well. We have breaking news here 20 minutes ago on EU data. This has been widely anticipated by ECB authorities, including, Lisa, you mentioned correctly, Lagarde. Andrew Langley summarizes for us at Bloomberg News. Euro area inflation to its lowest level in more than 2 years. The economy shrank I'm gonna editorialize and call that stag disinflation. Well, I think that's sort of where I am.
What I find interesting,
Mr. Summers will be like, Tom, don't say that.
What I find interesting is that the euro is gaining versus the dollar on this report, which really raises the question: what exactly are people looking for? Are they looking for growth to invest in a currency, to invest in a nation?
Yeah.
Or are they looking for just some sign that inflation is coming off the boil? And that, to me, the fact that that took the preeminence in terms of the responsive markets was really telling.
And I'm going to go to what you had in the brief today, which is the ECI index, which I really lean on, folks, wages and benefits combined. And I don't know what the number's going to be, but if you establish a disinflation vector in the wage package of America, that gets your attention. Further disinflationary trends, as we hear from David Rosenberg and Edward S. Hyman.
Wages haven't really led throughout all of this. They've actually picked up more over the past year than they had. What I find interesting is, do they continue to disinflate as much as people say, especially after the strike ended over in Detroit, especially with the losses that some of the companies are saying they're going to incur?
As you awake in America for global Wall Street, take out the dollar, euro, yen. Stunning over a span of 30-plus years. I have a 161 euro yen. We'll talk about that through surveillance this morning. On radio and television, this is Bloomberg.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
How concerned are you that Japanese buyers in particular, big corporate debt buyers in the U.S. are going to pull back, especially with some of the adjustments we're expecting from the Bank of Japan?
So we think that risk so far is moderate, but we do have to watch it. Again, the return on a hedged basis for a Japanese investor into U.S. corporate credit is not good. So we do need to watch that. We do need to see still if the flows on an unhedged basis continue. Our base case is that they do, but I think that's something subject to what we might see this week.
Andrew Sheets, always good, global head of corporate credit research at Morgan Stanley, with a piercing conversation yesterday. Good morning, John Farrell on assignment. He is back in the country. Good to see that from his cruise, and we hope to get him here in the next couple days. Lisa Bramlett and I here for Halloween. Lisa's going as a toxic brew. We don't. Somebody emailed in. They said, "Do you trick or treat together?" I said, "No, we don't. You know."
Toxic brew and
it's just too
don't
much.
go well together.
She takes, you know, it's like Leonard Cohen's song. You take Manhattan, and you know,
you take what, Brooklyn?
Brooklyn.
Yeah. How often you go there?
I went a couple of years ago. Actually,
Oh, wow.
The bridge was brand new at the time as well. Futures up 9, Dow futures up 130. I got a VIX under 20, 19.37. John Farrell out on Twitter yesterday highlighting the Dow Jones Industrial Average.
Yeah, with the real
is
burn.
a benchmark worth watching as well. The dollar flat. Let's go through those levels right now. Yen, 151 rounded up. That's stunning on dollar yen. Euro, 106.57 off the euro disinflation and contraction we just spoke of. Let us look at the chart right now of euro yen. This is what the adults look at. For those of you that lost in translation, pick the maroon carpet. Okay, euro Japanese yen is a depreciation of the yen of a stunning 40% from 2012. The dollar trade weighted, including all the other indices, thank you Deutsche Bank for this, up 46%, dollar strength that President Trump used to scream about. We are living it right now. A brief from Mark McCormick, Global Head of Foreign Exchange and EM Strategy, TD Securities. Mark, I want you to explain to our audience why a super strong dollar from 2012 and a super weak yen is disturbing.
Well, I think what it does is it just shows the massive divergence you have between central banks. I think one of the things that you can unpack is there are certain currencies that care about growth. There's certain currencies that care about commodities. There's certain currencies that care about different relative central bank functions. The thing that the yen cares a lot about is the 10-year point. If you look at euro cares about the 2-year point of the curve more than, say, the 10-year. And if you take the combination of what we had, and this is one of the most important things going on at FX, is the relative terms of trade shift. Japan is also a massive importer of energy and other commodities. So you take the commodity story, you take the rate differential story, and now you take the aggressive bear steepening of the U.S. curve since the summer, and you've got basically a trifecta of things that will weaken the yen quite considerably unless the BOJ does something.
Well, to the trifecta, let's go to Mundell of Columbia. I mentioned this with Vice Chairman Clarida the other day. He will join us, folks, for our special Fed coverage. Look for that. Is that tomorrow?
Yes.
It's tomorrow. The Fed meeting is tomorrow.
Gosh, again.
My people have just briefed me. And Mark, I'm looking at that. I want to echo what I talked to Professor Clarida about, which is something has to give here. When something gives, what is the instability our audiences should be worried about?
Well, I think in the context of the yen, what needs to give is the currency itself. As you mentioned, there is a very interesting policy mix where fiscal policy is actually quite favorable in terms of growth. Also, inflation. You see the BOJ is expecting higher inflation to kind of be a bit more sticky, I think, than markets are looking for. And they've also basically said we don't have a cap anymore. It can go above 1%. So I think what they're trying to do is synchronize themselves a little bit, which has been U.S. yields rising, which would contain the weakness in the yen. But this is not a policy mix that is coherent, and it is no longer sustainable. So I think a big thing is what we're going to see is things are going to change. They will change abruptly. But I think the movement that we had overnight where they said there's no longer a 1% cap is actually quite a significant change, but it will take time for this to work through the market. So again, I'd say that the thing that needs to break is yields need to be higher, yen needs to be stronger. It's just going to take more time because we also need to see a peak in the U.S. yield story, which again is not even about the Fed anymore when we talk about the 10-year yield. It's more about supply and demand for 10-year bonds.
This is a big mishmash. Do you have a sense of what the response mechanism from the Bank of Japan is, what the lines in the sand are, what they're sort of looking at? I mean, we were talking about some of the opacity that they put forward overnight.
It's very tricky because I think obviously most central banks, it's very common language at this point. They care more about the currency movements. So the yen has not been as volatile. So, as you can see, we have not, the report came out this morning, like they did not intervene last month. So I don't think there's a red line per se. I think they're all kind of doing what everyone in the market's doing. They're very confused about the drivers. They're very confused about the actual themes in the market. FX has become very challenged, I think, for many people. So I think the line in the sand is you're kind of thinking it's loose fiscal policy, loose monetary policy, weakest currency on record. It deviated from our longer term models by magnitudes. Our longer term fair value model in dollar yen is in 120s. So what you're kind of looking for is like the pressure points that will cause these things to break. And again, I think a big part of it is U.S. data needs to roll over. U.S. yields need to come down a little bit. And the BOJ, I think the one thing that we're very out of consensus on is we are looking for them to move out of NIRP next year because of the wage pressure we're seeing in Japan. Right around the Shinto wage negotiations, we should see higher wages. And as a result of essentially higher wages and higher nominal rates coming up, we should see real rates in Japan move substantially in their favor versus the U.S. next year.
When you take a step back, there's a question of slowly or all at once. And you were saying it will be all at once at some point. How disruptive is this going to be at a time when so many people were talking about Japanese flows underpinning or basically suppressing yields globally and really keeping things a little bit more in sync?
Yeah, I think that's a big component, because I think since the summer, since the BOJ let the kind of opened up the yield curve control, the suppression they had on it, we have seen term premium rise across the world. We have seen the U.S. 10-year rise. So I do think that there is a blowback here that's happening slowly behind the scenes. And again, I think a lot of people will make the point that the 10-year yield is now advanced above Fed expectations for 2024. It's above data surprises. It's above U.S. data trends. It's no longer reflecting the correlations we saw in July. So I do think that the BOJ and the fact that they're kind of moving out of it, obviously quantitative tightening has a component of this as well, but the BOJ does have the ability to kickstart, rises in the U.S. 10-year as well.
Bring up this board again on television and radio. I have to review you this. I didn't do this. Simon did this in the control room. He's been reading Michael Rosenberg on foreign exchange. Bring up that board again here. Yen, 151. Weak yen. 2-year yield, finally above zero. 10-year yield, almost 1%. Those are unimaginable numbers to pros. Mark, is this going to end stochastically? I talked to Martin Feldstein about this years ago. Like Loonie, let's go to Toronto Dominion Bank. Loonie goes up 138, you get up to 142, and it gets fixed. Is that where we're heading, where the system just fixes itself?
No, I think the system's quite dynamic. I think that's the interesting point. Like we run variations of lots of different types of tools and models and different things. We're trying to understand what's going on in the market. As I mentioned, the things that are driving a weaker yen are fundamentally based. They make a lot of sense. And again, the commodity story behind the scene is quite important, especially from the handover to last year, because what it does is it eliminates the trade surplus, and the trade surplus plus the current account plus the balance of payments. That is FX. Essentially everything we talk about every day is trying to think about how do we predict the balance of payments. So for the yen, I don't think any of this is stable. I think it's a very unstable equilibrium. Even the shorter term models that we look at that we use for trading ideas, dollar yen should be at 145 based on rate differentials and equities and risk and these kind of things. So it's even deviated now because markets are looking for a trend to trade, and dollar yen is the only one that makes any sense right now.
3 people just drove off the Garden State Parkway. There's your Global Wall Street brief on foreign exchange. If you only understood half of that like I did, he's Mark McCormick of TD Securities. Can I talk about the greatest ad campaign ever?
Please.
I remember when Halloween changed, and it was like kids, it was like fun, kids and all that. And the people out in Golden, Colorado invented Elvira. And now, you look up, there's a survey here of the 3 top things for Halloween. It's like Kit Kat bars, duh.
Yeah.
M&M's, duh. I like peanuts is what I like.
I agree with that.
Okay, and the third one is Coors Light. And Coors, think about it. Coors beer changed a holiday in America with Elvira and all that.
To take it from kids going around and getting candy to the parents sitting there getting drunk as they hand out candy, is that what you're saying?
I'm Tom Keene. Bloomberg Surveillance. Who's with me? The queen of Halloween, Lisa Abramovich.
Oh, yeah.
That's me, Max. What's up? How are you? I have been writing about Wall Street for almost 15 years. And what that means is I write about feuds and rage and rises and falls and comebacks. And every now and then, I also write about a couple of villains. Thank you so much. And now, I am about to do something new and very, very scary. We are making a show, and it's based on Bloomberg Businessweek magazine. So what is this show about? It's a show about money, power, culture, pop business. We're gonna ask complicated and profound people about their ideas, their careers, their lives, their risks, their failures, their imagination.
It's so incredibly liberating not to care what other people think.
I was giving my tools to other communities. I wanted to bring those tools home.
Tune in. Please, really actually tune in. I desperately need an audience.
The top names in business are on Bloomberg.
I see a world where financial conditions have gotten tighter, and the transition mechanism, which the Fed would like to see in slowing down the economy, which we all expected, it's taken a lot longer. So the real impact of higher costs around the globe, in the US and Western Europe, it's not been felt yet. And so when people say, well, we're going to have a soft landing, I'm skeptical.
Nobody covers business like Bloomberg. Context changes everything.
Bloomberg surveillance. Barry Ritholtz emailed in and goes, are you really going as yield curve control? I said, yes, Barry. I was going to go as gamma, but that's so.
And how does your outfit change to be
yield curve control? It's really good. I just go as a Japanese boy band, and everybody understands what I'm doing. I mean, it works out. It works out great. It's like BTS except Japan. I mean, it works out. Futures up 9, Dow futures up 138. We're under 20, 19.36 on the VIX, and we've got some serious news. I'm gonna truncate this because we got to go under surveillance before we go over Joe Moek. But the answer is, I'm sorry, everybody's fighting the last war, and things are shifting. Pay attention today, into the Fed meeting tomorrow, into Apple earnings on Thursday. Bramo, 2 MacBooks in the last 24 hours. Ordered the new toys.
Well, let me tell you, those things are expensive, and all the different plugs, they charge you for everything.
Yeah,
it's ridiculous.
Yeah, where do you get the AirPods refill? Under surveillance with the queen of Halloween.
All right, under the surveillance, shifting gears quite a bit. This morning, Israel striking targets in Lebanon and Syria as ground operations in Gaza are expanded. An Israeli military spokesperson saying, quote, tanks and other vehicles are moving through northern Gaza looking for Hamas and engaging with their combatants. This as the humanitarian crisis worsens. An Israeli minister telling Bloomberg that a greater number of supplies would be allowed in from Egypt starting today or tomorrow. Tom, there are a number of different points here. First of all, the humanitarian catastrophe is deeply upsetting. It's unmeasurable. And it's something that we're watching unfold in very much real time, in pictures, on social media, et cetera. And a lot of it has been cut out because of a lack of electricity. But then there's a definite opacity also about what the ground operation actually looks like that Israel is waging.
I think we're redefining the word terror. And I'm going to leave this to experts as well. I read every word of Robert Gates, an American former Secretary of Defense, CIA, in the new Foreign Affairs. We'll talk about that later, but the immediacy here of what we think, you think, I think, everyone thinks, and expanding it out to a broader frontier, a broader war. Witness what Oliver Crook said about Yemen and Saudi Arabia overnight.
And that's going to be a story that we're going to be following for quite a while. We've been talking about this all morning. The Bank of Japan easing its grip on long-term government bond yields in a modest policy tweak. The Bank of Japan saying it will take a more flexible approach to controlling yields on 10-year government debt, saying the previous 1% level is now a reference point. Right, whatever that means. The yen extended declines against the dollar this morning, perhaps because people expected more. But you do see that 10-year yield climbing pretty significantly.
Do they have dots?
It would be a, impressionistic sort of, dot experience.
Like, a yen Zen experience. I don't.
To that point, though, we do have dots in terms of their inflation forecast for this year, next year, and the year after. And you do see inflation, core inflation, climbing above their 2% target for 2023 and 2024, but not for 2025. But how this is really influencing some of these tweaks is going to be interesting, and how this percolates out into other markets.
What else do you have?
X, the platform formerly known as Twitter, is now valued at $19 billion. That is less than half of the $44 billion that Elon Musk paid last year. X has seen a 60% drop in ad sales, largely due to looser content safety rules. Musk's plan is to shift away from advertising toward paid subscriptions, but so far, less than 1% of users have signed up for the monthly premium service. This has been a big question mark. There's a lot of debt tied to this, but this is also, it used to be the town hall, where people would really voice their opinions, their concerns, their news,
come on,
etc.
get the surveillance cork out. Put it
No,
in my
I
mouth.
want to hear what you have to say.
No, you don't, because I'll go in the timeout chair. I mean, you know, they won't like what I say. And it's just, I can't, just shut up, Tom. Let's move from Twitter here and the useless value of X. I didn't editorialize there. Quickly, earnings. While you were talking, earnings came out. JetBlue craters, like other airlines here. Caterpillar up 3%. Caterpillar with a nice pop here of industrial America. We're going to dive into that as well. But again, this is about pricing power at Caterpillar. JetBlue does not have pricing power, period.
They revised lower their full-year revenue forecast to 3 to 5% of gain. They had previously seen 6 to 9% of a gain. They also saw a bigger adjusted loss per share in the third quarter of 39 cents versus 28 cents. But ultimately, how much is this domestic versus international? How much is this because of what we're seeing with oil prices and fixed costs? And how much is this just in general? People have gotten it out of their system. They're done. And frankly, the experience hasn't gotten that much better. In fact, it's gotten significantly worse. So people aren't flying as much.
The other thing here is to talk about industrial America. I've got 109,000 employees at Caterpillar. Caterpillar, folks, with the CFA is widely followed because in level 1 CFA, you tear apart John Deere and Caterpillar's accounting statement. So we look at Caterpillar, and I'm sorry, I got a 242 out to a 250 here. And if I look at the margins, you come down the income statement of profitable Caterpillar, it's terrible. They're doing, you know, like Gartman says, they're dropping things on your toes and it hurts. They're making 22 cents per dollar on the EBITDA line. The net income is, I'm going to say, double Ford at 15%. This company's making money.
So there are a lot of questions here. First is the idiosyncratic stories and the specific micro stories behind why this company is doing well. But then there's also a question of, we saw services inflation. Is it cooling a little bit? And are we seeing a reinflation of goods as people go back to stuff, as people build stuff? And that, I think, will be an interesting macro.
The arch theme is disinflation in goods, and then there's services to worry about. Maybe in Europe, it's a different story. We get a brief today from the wonderful Gilles Moek, Chief Economist at AXA Group Paris, Head of Research at AXA Investment Managers. Gilles, just honored to have you on with us today. How happy is Christine Lagarde this morning?
She probably feels vindicated because she was very cautious last week, and the ECB has, I think, quite clearly changed tone. I think changed tone more than what could have been expected. And the slew of data we had today is confirming that definitely military policy needs to be cautious because we have good news on inflation. Disinflation is really being confirmed. It's not just about headline, but also about core, which obviously matters more to the ECB. And unfortunately, this comes with a price, and the price for this disinflation is an economy which is not doing well. So we've had a small contraction in GDP. So, yeah, ex post, I don't know if the hawks were very vocal at the meeting last week, but any sort of cautious line from the ECB is supported.
Tell us of the relative dynamism, to steal from Ned Phelps, the laureate of Columbia. Tell us about a dynamic America in a Europe maybe less dynamic, where Lagarde has fewer degrees of freedom to move with disinflation, with, you know, what I'm calling this morning Euro stag disinflation. With that, does she have fewer choices forward?
I think one of the issues the ECB has is that all this comes with a pretty steep depreciation in the euro, and that's a particular challenge for the eurozone, which is a more open economy than the US. So, if you're a central bank and you see that core inflation is falling, and the economy is softening faster than the US, quite clearly, you might be tempted to say, look, not now, but maybe in 2024, I may cut a bit faster than the Fed. The problem if you do that is that you're going to trigger a further depreciation of the currency, and you're going to fuel imported inflation through core. So that's a significant issue for the ECB. And there is another problem, I think, which is that politically, I think the governing council is not yet ready to contemplate actually a change of stance. There's a constituency of hawks who are not now clamoring for more tightening, but who will probably resist any quick change of stance, arguing that the ECB has been too slow to react to the surge in inflation. So my impression is that at the Fed, the sense of consensus is probably higher within the FOMC. There are nuances, of course, but there seems to be a stronger consensus. It's going to be hard to build at the ECB in the same way that it has at the Fed.
You said that Europe is paying the price for disinflation. It doesn't seem like the U.S. is paying the price for disinflation, which raises a question of whether it's real, right? And do you think that in some ways the disinflation, God, I'm gonna get crushed by Tom later, is the disinflation more transitory in the U.S. than in Europe? Basically, are we going to see a reinflation? Is there a greater chance of that in the U.S. because we're not paying the price for a slower pace of inflation?
For sure. This resilience it's become a cottage industry to try to find reasons for this resilience in the U.S., but it's day in, day out, the accumulation of data is quite obvious. I think one key issue the U.S. has is that for the time being, there is still no sense that the labor market is really lending. Wage growth seems to have slowed down, and the ECI today is going to be very, very important to really make sure that. So that's a relief, but there's just so much job creation at the moment that you could be excused for being a hawk at the Fed right now and say, look, we're definitely not in the market for cutting rates anytime soon, and there's the possibility that yes, they will have to hike further. I think the situation is different in Europe. We have what we should have expected all the time, which is that when you bring interest rates, policy rates to what is twice now, what is the upper end of what is estimated to be the neutral rate in Europe, well, it triggers pain. And the pain is plain to see. It's not all because of monetary policy. We have our weakness. We have, in particular, the legacy of the energy shock that we had a year ago. That has nothing to do with monetary policy, but clearly it's not helping.
I do have to wonder what's exactly driving borrowing costs, though. Is it central banks or is it something else? In the U.S., I was surprised to see yields lower, substantially lower, even with the Bank of Japan tweaks around the edges. A lot of people just pointing to the refinancing agreement and the fact that the Treasury Department is actually coming in a little bit below estimates of how much they're going to have to borrow in the third quarter. How much is this the whole story right now in terms of the incremental gains or declines when it comes to borrowing costs in the U.S.?
I think, honestly, we've had a lot of movements over the last few weeks, which to me tend to be pretty technical, and it seems that every time the US gets close to the 5% psychological threshold when it comes to 10-year yields, it triggers some sort of buying in the market, and things improve a bit. And then yes, you've got those news around the borrowing requirement, and maybe the fact that the Treasury is going to issue more bills and a bit less on the long end of the curve. That may also have explained some of it. I'm actually, from a fundamental point of view, I'm getting quite interested in the current debate on the neutral rate, where the neutral rate is in the US right now. And it's fairly easy in the US to build a case for the equilibrium rate having risen. And the resilience of the US economy to the current tightening would be one of the pieces of evidence towards this high equilibrium rate. You don't have that evidence at all in Europe. And our problem, I would say, as usual, is spillover, contagion. There is no reason why long-term yields should be as high as they are probably right now in the Eurozone. But we're getting some contagion from the US.
Gilles-Marc, thank you for the brief. Greatly appreciated. If you're just joining us, shocking news from Europe as we see disinflation and also contraction as well. Lisa, this is really the heart of the matter, and I've seen it in the zeitgeist in the last 72 hours, which is the level of restriction away from the actual Mike McKee data. And the answer is we're talking 5-ish%, and adults are looking at how the markets have moved, and they throw 200 beeps on there, where it's a 7% Fed policy right now, not 5%, because of these adjacent moves in the market.
And what you have seen, in addition to this idea that you are seeing a slowdown on the edges, and then even more so in the U.S., despite the headline data, that constriction is bleeding over into credit, and you are seeing spreads start to widen out. You are starting to see credit reflect the potential that some of these companies are going to have a weaker business model if they've got to pay that much higher borrowing costs.
We're going to have to see on that as well. I've got lots coming up here, but I really want to go back here to Japanese yen. It may be removed from some of you, not part of global Wall Street, but we're all getting up to speed here on what's going. Here are two currency pairs. Dollar yen, which was 95, 110, 120, now out to 151, rounded up, weaker yen. And euro yen, which is what the pros look at, to a stunning 161. Coming up on Japan as an emerging market, Damien Sassower will join us with Bloomberg Intelligence. The television star Damien Sassower will join us. You know, he's like, you know, I think it's like saying, see ya, Tom. This is Bloomberg. Good morning.
I think this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some points that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
This is Daybreak Europe. I'm Kriti Gupta. Let's get to the stories that set your agenda.
Taking you from the U.S. market's close.
A lot of this was priced into the U.S. session.
To the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television. The top names in global leadership are on Bloomberg.
The conflict between the U.S. and China has escalated so much. This is one of my greatest fears, that the small nation is forced to choose sides.
Bloomberg. Context changes everything.
What we try to stress is not that China is uninvestable per se. It's that you can't invest in China like you did, 10 years ago, even 5 years ago, because the risks are so much more dramatic. What a lot of large asset managers in particular were used to for many years is, they invested in their big tech companies. They loved their Alibabas and their Tencents, and they were just used to just collecting dividends on a regular basis and watching the stuff go up. That era is completely over.
Smartest guy in the block. It's a big block in China. Leland Miller, China Beige Book. I can't say enough about the gentleman from the University of Virginia. Leland Miller is encyclopedic on the granularity of China, and it was good to get that brief as well. Lisa, we've got an important guest here. And I don't know, is Japan an emerging market this morning?
It's quite the opposite, I
40%
think, based on
from 2000.
some of the growth that they're experiencing. But in China, we've really been focused on just the state of the economy and the lack of certainty around that. The latest data out of China really signaling massive weakness, sort of fragility in this nation's economy, both manufacturing and non-manufacturing PMIs for October, falling below estimates and down from a month earlier. This has been the perennial question. Just how weak are they? Damien Sassower, haven't seen you in a long time, Chief Emerging Markets Credit Strategist.
Happy
for Bloomberg
Halloween.
Intelligence. Happy Halloween.
You
I'm
sick of
going
me yet?
evidently as a toxic brew. But I'm curious from your vantage point, How weak is this economy?
It's pretty weak. It reiterates the fragility of the economic recovery in China. I mean, we knew it was going to be a weak number. We had the 8-day golden week leading in the beginning of October. But at the end of the day, for manufacturing, the manufacturing PMI to slip back into contraction, for non-man to slip back into weakness, I mean, not quite a contraction, it's a pretty big deal. And on the small firm side, which is responsible for most of the employment in that economy, it's terribly weak, way into contraction, and things are just not getting better. We expect now 5.2% GDP growth this year, 4.5% in 2024, and we expect a rate cut before the end of the year.
Does this matter? If ultimately the question hasn't been how weak is the economy, the question has been how much firepower are Chinese authorities going to put behind it? Is that really just squarely the question, and continues to be after they have made initial moves, but some people are saying maybe not enough?
Well, Lisa, we talked about this yesterday,
we
right?
Did.
I mean, the 130
You were here
billion.
yesterday?
I was. Where were you? You weren't here.
No, I was on sabbatical.
Okay. $130 billion expansion of their fiscal deficit into year-end is kind of unprecedented from a China perspective, right? And the fact is they're going to need to cut rates in order to kind of smooth out liquidity in the market in order to digest all that debt they're going to have to issue in order to fund that, right? So, it's going to be an interesting year-end turn, I think, in China, which has now, quite frankly, become a funding currency on par with your friend, the Japanese yen. And so, that's really what we're talking about here. And I think some of the measures, sorry to cut you off, Tom, I just have to say it, that the BOJ have taken today.
Continue.
Carry on.
We're priced in by the market. So all this hype about 160 euro yen, $155 yen, I mean, look, you see the market's already bringing it back a bit. Levels are still really low in Japan, and rate differentials are still really wide when compared to Europe and the US.
I want you to explain how you make money in the Damien Sassower world with currency depreciation. This ever stronger dollar. If we had President Trump now, he'd be apoplectic about the strong dollar right now. I've got FX depreciation in a frontier economy like Japan. I've got FX depreciation in an EM like Indonesia. You pick the country better than me. What in God's name does that do to my EM total return?
Right, total return is exactly the point. There's an interest rate component and there's a spot component. Spot is simply movement in the currency itself, which kind of reflects the theme of the day. Maybe it's growth, maybe it's inflation, what have you, but it's that interest rate return which is key, right? So you're not getting much of a return, I mean, in places like Japan and China and a lot of the low-yielding Asian blocks. So, they have tended to be good funding currencies relative to the high yielders in Brazil, Colombia. And notice I'm using both of those economies because Colombia announces on interest rates today. Their policy rate's 13.25%.
So what do they do? Okay, stop there. This is folks, this is why we have Damien on, even when I'm not here. They have a rate of 13%, which everybody out here understands business doesn't run. I get that. What do they do besides call 1-800-GORGIEVA and say, help us? What's their choice set?
I think the risk when you're investing in a high-yielding economy like a Colombia is that it's very liquid, right? And once you're in that economy and clipping that coupon, getting out isn't as easy.
You're addicted to it.
Getting out isn't as easy. It's just not like overnight. Like you can sell your Colombian peso, get your dollars back. I mean, it takes time, There's a T plus something days until you can actually pull your money out. And in that amount of time, if your block is big enough, you can move the market quite considerably.
Okay, fine. But then does that mean we're towards, pick the date, 1992, 1994, the August of 1998? Are we getting near a point where EM, there's not enough oil in the engine to make the Damien Sassower world go like the Detroit Lions 6-2?
Lisa, Tom's been reading my research because he knows that this reminds me a lot of the mid-90s period. I mean, it really, truly does. To me, it's just my opinion.
I don't know what I'm talking about, and it does.
Things are breaking offshore. I mean, I say it all the time. In frontier markets that no one cares about, like Nigeria, Kenya, Ghana, currencies have been devalued by 50%. Things are breaking, but we just don't feel it here yet. And so this reminds me a lot of the mid-90s, but this time we're not as close to it as we were in the mid-90s when Asia started to roll over, Thailand, the Asian debt crisis, the tequila crisis of Mexico, et cetera. But nevertheless, it does feel to me to be quite similar.
Is there a long-term capital management? I mean, if you're going to go to the mid-1990s and you talk about something, if you're going to talk about something breaking, always the gloom. He was basically leading it off.
I don't like to think so, Citadel. No, I'm kidding. I'm joking. I never said that. But what I would say is, look, there are big firms out there that are not necessarily your traditional hedge funds, your traditional banks, your traditional players, non-bank financial institutions, whatever you want to call it, shadow banking, et cetera. Yeah, there could be some pockets of distress that bubble to the surface when things get really tight. And I think what we're seeing in cross-asset vol right now, Lisa, is the market valuations are finally responding to tight financial conditions. And we see that just alone if you look at rate fall, which is trading at a premium to equity volatility.
Honestly, we've been trying to grapple with what would break given how quickly yields have gone up. And we're talking now about the Bank of Japan potentially abandoning yield curve control. We're talking about the potential for economic growth in the engine in China rolling over. Jeremy Stein, the former Fed governor, who is very colorful with his words, said in a recent Bloomberg article, if you had told me 2 years ago that the Fed would hike by this much in such a short time, I would have said that they would leave dead bodies littered across the corporate credit landscape. I really don't have any good story to explain why things have instead remained so resilient. Are you saying that they're not? It just is taking longer.
First thing I'm saying is I have to apologize to Ken Griffin because Citadel's a wonderful company and they employ a lot of my friends and they invest really well. And I just want to apologize. I just got this vision of Ken Griffin calling me now. Anyway, no, I'm kidding. So the question was, I think, the resilience of investors in this environment?
Just in terms of when you talk about the emerging market complex, the fragilities that you're seeing, do they look akin to what people were expecting when you raise rates by 500 basis points in less than 2 years?
Yeah, no, I think so. I've been calling for this for a while. I think a lot of my peers have been calling for it. You can't really invest in EM local until the U.S. really starts to cut, and the U.S. seems to be on hold for a lot longer, and you know, that runway seems to be expanding by the minute. So, you know, I think that's why EMFX is on its back. EM local rates, I mean, they've given up so much performance in just the last month alone, and I think it's justified.
Right. Robert Mundell, like 2000-ish, dollarize. He told Canada is an EM to dollarize against the United States. Should Argentina dollarize now?
They don't have the ability to.
They don't, please
They
explain that to our
generally
audience.
don't have
This is
enough dollars in the system to function, and that's what dollarization means. Peru's a
They
little
don't
bit of a
have
different. They don't have dollars.
They don't have the wealth.
Right, correct.
They don't have the balance sheet. When people say the United Kingdom is poor, it's about wealth.
Correct.
Strange word.
Correct. And you know what I've been looking at, which is really interesting, just taking you back to Japan and looking at domestic household wealth. You want to talk about domestic households in Japan are funding in local currency and investing abroad. They all have little, you know, trading accounts set up where they're basically buying dollars. They're buying Brazilian real. They're buying Indonesian rupiah in their PAs, in their personal accounts right now as we speak. And those volumes are exploding and have been for some time now. And that is just indicative of what's going on in Japan, that they've kept yields so low for so long, that is embedded in the sentiment in how these households have to operate and invest their money in order to kind of pay for things.
But the distinction here is the people of Japan and other nations are wealthy, quote unquote. This strange word wealth, folks. Versus Argentina doesn't have the underlying wealth to dollarize,
That's
right?
correct, yeah. No, I mean, that economy would not be able to function, would cease to function, you know, if they tried to dollarize. I don't know how Malay would be able to do that. Malay is obviously the one who is a proponent of that. You know, we have a big election coming up in the next few weeks in Argentina. But I mean, there's also, it looks like it's going to be Sergio Massa again, which is unbelievable. It's more of the same in Argentina. How does the IMF continue to get behind them?
Did you, I mean, you're big buds with Ken Griffith and Citadel. Did you go to Disneyland in Tokyo?
I didn't. I would have liked to. I'm definitely not getting the invite for next year. No, I don't think so. Not after today.
I mean, is he with us tomorrow as well? It's like every day with Damien. I feel like I'm on The View. You know, I got to my Whoopi imitation.
Oh, good luck with that.
I feel like I'm in The View here.
Next Halloween.
Damien, thank you so much. Please come by tomorrow as well. Damien Sassower, brilliant on emerging markets. He's with Bloomberg Intelligence. Markets on the move. Futures up 9. A nice tape here early on. Again, yen weakens. Emily Rowland of Boston next.
Earnings season is here.
Tons going on, lots of earnings. Beat wherever you look.
Bloomberg breaks the numbers first.
It's a tale of two earnings. Results from Goldman Sachs, Bank of America, and Morgan Stanley.
Netflix is out, guys.
With exclusive expert analysis.
Recovery is underway.
They crushed it. It was one of their best quarters ever.
This is a story all about pricing power. We're going to make more money. We're going to make more money. And we're going to make more money.
You're making bank. And I think that is what we can take away.
Bloomberg Television and Radio. Context changes everything. Venture capital. It's been volatile. From bank crisis anxiety to AI exuberance, Caroline Hyde and Ed Ludlow chat with the biggest names about the latest tech trends.
Is AI going to dominate the earnings narrative for this sector this week?
I think we're seeing opportunity and potential platform shift that we haven't seen in a long time.
If you're a company today and you're not embracing the changes that are taking place with AI,
you're going to be behind.
How do you prove to the investor base that you haven't just tacked on AI to make yourself sexy?
It's very hard to differentiate if you're not experienced with AI.
The startup stories.
We think this is a watershed moment for technology.
Certain categories are more exciting than others. Right now, obviously, generative AI is a category that is very exciting to startup founders, customers, and venture capitalists as well.
So what we are seeing is a new area of opportunities for new founders to come and change the industries that matter.
And the real talk on realistic valuations.
Some of the best opportunities are sitting right in front of us.
How do you discern which ones are good on the marketplace right now?
I think founders have woken up to the reality that taking on more money at higher terms doesn't necessarily play to their benefit in the long run.
How do you actually invest?
Follow the VC money on Bloomberg Technology, the only daily business show dedicated to tech right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television. Top names at the Fed are on Bloomberg.
The economy is handling much higher rates, at least for now, without difficulty. So notionally, that might tell you that the neutral rate has risen, or it may just tell you that we haven't had rates high enough for long enough.
The bond market has tightened quite considerably. If financial conditions are sufficiently tight, our work is not necessary because we don't need to boost them more.
Nobody covers the Fed like Bloomberg. Context changes everything.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
If you look at the economic data today, it is so significantly consistent with a downturn.
Stocks are in a bit more of a wait-and-see mode.
It feels like anytime there's a part of the market that gets a little bit of leadership, it can't sustain it for that long.
The Fed is probably going to want to keep its options open to hike more.
The Fed is just well ahead of other central banks.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene on radio and television. It is an eventful day before a Fed meeting tomorrow. We'll touch on Halloween here in a moment. Trick or treat, and you see it in Japan. For Global Wall Street this morning, it's simple. Finally, yen moves. The government has not intervened in any way, shape, or form. I got a 161 euro yen, dollar yen 151, and you wonder, it's far, far away, but it's not, Lisa. Japan matters.
Japan was one of the biggest buyers of U.S. securities, in particular corporate credit and U.S. treasuries. If they pull out of the market and can actually get yield, then that's going to make a big difference. And suddenly they can get yield. You get almost 1% now in a Japanese 10-year. It's a market, Tom.
We're looking here at a number of other narratives. Just as we went to air at 6 a.m. on radio, on television, Europe in what I'm calling stag disinflation. Finally, disinflationary trend in place. Thank you, Gilles Moecken, for that. But with it, a surprise, maybe a pan-European contraction like what we've seen in Germany.
We saw a 0.1% contraction in the third quarter. It was expected to be flat. We saw disinflation. This, to me, was the big takeaway from it. Yes, people know that European economies are not doing that great, but the disinflation, consumer prices coming in, increasing at 2.9% versus 3.1%. That's really what moved the market, Tom.
Well, we're going to have to see. Apple, with their announcement last night, Lisa hung on every word. She says, let's go to the store before I go to work at 3 a.m. But other earnings out as well. We got Apple on Thursday, I think. And the 3 MacBooks you bought is not going to be in their earnings report this time around. But we've got some surprises here. JetBlue, no surprise. Caterpillar, what do you think?
Well, Caterpillar came out better than expected. and then the shares have come off. So we have to dig through the earnings and to understand what's behind that. With JetBlue, yeah, we understood that they were going to be facing some costs, but the magnitude of those costs and the magnitude of just how much their full year revenue forecasts came in, that came as a surprise. And that's why you see those shares down quite materially.
Maybe it's a weak outlook forward. We'll touch on that and under surveillance this morning as well. We need a brief, and critically, Lisa starts this morning with what matters in America: strong jobs, but wages, the mystery.
Well, this whole week is really about labor market data in all its nuances. And today, a lot of people are pointing to 8:30 a.m. as one of the key data points, even with the jobs report on Friday, even with initial jobless claims on Thursday. We get U.S. employment cost index for the third quarter, which gives you a sense of full compensation and how much it's increasing, the pace of the increase. It's been increasing at a slower pace, but how much do we need to see this continue to come down to really give people confidence that we can disinflate even without taking the pain?
You know, on radio, it's tough to see the chart, but we do charts on radio. It works. Thank you. You know, out in Sparta, they want to hear charts on radio. The chart is a disinflationary vector, but it's got a ways to go to get back to where we were pre-pandemic.
Correct, and this is something people are watching closely, especially in light of all the strikes. At 9:30 a.m. on the geopolitical front, we're going to hear from Secretary of State Antony Blinken and Defense Secretary Lloyd Austin. They are testifying in front of the Senate Appropriations Committee. To me, it's going to be really interesting how they try to get the Senate to kind of jawbone the House into some sort of consensus. So far, we've gotten a proposal from the House that is a no-go for the Democrats, and it's a no-go when it comes to the Senate.
I thought Oliver Crook's report in the last hour was brutal from Tel Aviv, and I'm really looking forward to Amory Horton joining us in about 12 minutes here. I mean, AMH on what Washington does about a multi-front war, to me, is the away from the humanitarian agony. The multi-frontness of this is something.
Yeah, and how the U.S. passes $155 billion of new spending at a time where there is growing concern about the deficit and the way of financing it and earnings today. We already talked about some of them.
I love to do this. I love to front-run Lisa's brief. She spends hours with her interns putting this together. And to get out front of earnings and crush you as you talk about JetBlue, Caterpillar, and Pfizer. I mean, why don't you help us here with a further earnings report?
I'm just crushed. I'm just sitting here crying inside, Tom. You know, honestly, no, to me, I'm actually very interested. There are 29 companies reporting today. There have been 260 S&P 500 companies that have reported so far about that. So more than halfway through. I'm actually most interested in Pfizer and AMD. So don't worry, you didn't steal my thunder. On one hand, healthcare stocks, a real question about how much they got a boost from the pandemic that's now fading.
So they're back to normal.
Well, are they, or have they been inflated? Can we go back to Ozempic? And then the question is, with AMD, the chips, is everyone buying a new computer? Are some people getting sticker shock when they go to the store and realize that they have to spend that much money on absolutely every single component of a phone that they're buying newly from a store?
From Apple, which
just theoretically.
Was Bramo theoretically here in the last number of hours. You got a personal call from Mr. Paulson at Goldman Sachs on that, using that Apple card.
Exactly.
Bramo, thank you. It's good of you to do that. Right now, she pulled a short straw. Worst child abuse on Halloween. Emily Rowland of the John Hancock Company made her kids go as Red Sox players for Halloween. This is abuse. They were so bad this year. You know, come on, Emily, you got to do better than that. Maybe go as Bruins. They're doing better than good. Emily Rowland this morning from Boston here on a Halloween. What's your biggest fear out there besides trick-or-treating? What's your biggest fear, Emily, in this market?
My biggest fear is that we're actually in a scary movie right now, but it's not over yet. You know, you think about the villain kind of being wounded but still alive, and the villain is higher borrowing costs in the wake of the Fed raising interest rates in the shortest amount of time and the greatest extent in several decades here. And we really haven't felt the sting from that as far as consumers pulling back, you know, as far as earnings getting hurt by that, profit margins getting crushed. So everything's fine right now. We're sort of running to the safe part of the house as we're getting chased by this villain, but we need to remember that the movie simply isn't over yet.
Oh my God, Emily, I'm just thinking about you at the sleepover with a bunch of 11-year-olds saying it's a scary house, the Bond villain is coming to get you. At some point, I'm wondering, Emily, how much we're looking at a scenario where yields have kind of reached a peak and that really the uncertainty lies, and I keep harping on this, but it lies with the deficit financing and what we get tomorrow from the Treasury Department. What we got yesterday actually underwhelmed with the amount that the U.S. would have to borrow in the third quarter. And arguably, that's what's leading yields lower this morning.
Yeah, certainly fears around supply have been a key to the narrative around rising bond yields, but it's not like we woke up one morning over the last few weeks and all of a sudden found out that the Treasury was going to have to issue more debt. That's been a known issue. So for us, that's not really the primary reason that bond yields have picked up. It's been just this unrelenting strength in the economic data in the U.S. And certainly fiscal spending has played a role in that. Excess savings have played a role in that in 2020 and 2021. But really, it's been the strength of the data. There's something really, really unusual happening in the bond market right now. One, we're facing down potentially the third consecutive year of negative returns for high quality bonds. That's never happened before in history. We're also looking at an environment where if the Fed was done in July, and we can talk about that, it's really unusual to see the 10-year Treasury yield continuing to rise. Typically what happens is that the 10-year peaks right around the same time or just before the Fed pauses. Very unusual. And then finally, the elusive bear steepener. Another very notable dynamic here that is not consistent with what we've seen in recent history. So our view is that we could be getting close here to the peak in yields.
This doesn't sound like a scary story, actually. Arguably, and as Gina Martin-Adams yesterday was saying, this really speaks to a pain trade of more momentum, of gains, of a rally in risk assets, because if yields are rising because of growth, isn't that a good and beautiful thing?
Yeah, I mean, I think our standards for growth have seemed to be shifted a little bit. Yes, there's a lot of strength in the labor market, but we all know that that's lagging data, and those cracks are starting to form. I think this week's going to be really critical in terms of the jobs report on Friday, initial claims, which have stayed stubbornly low. We've got to remember that that data is subject to heavy revisions, and we're seeing a lot of cracks in the consumer story starting to emerge. There's a lot of headwinds out there. The resumption of student loan payments, credit card interest rates at 25% right now, auto loans at 7%, mortgage rates over 8%. That's a challenge.
How do you get out 36 months? You're going to tell me part of a carefully managed portfolio is to look out 3 years, 5 years, 10 years, maybe when the Red Sox go above 500 again. Emily, the basic idea here is people are scared stiff. How much cash at 5x% should they own versus having the courage to reach out 36 months?
Yeah, I think the scary part, I guess, about being in cash right now is that you're subject to significant reinvestment risk. Our view is that the normal relationship with the economic cycle and bond yields remarries as we head into this economic contraction into next year. And in that environment, you want to move out the curve and just really be able to capture the 5-6% income that you're seeing in high quality bonds right now. I know we've been talking about this for a while. There's been these significant odd dislocations in the bond market, but if you're in cash right now, you might not get that yield next year. We have an opportunity to lock that income stream in for years, and I think we're going to look back on this as quite an incredible opportunity to unlock the value in bonds.
Thank you. Emily Rowland, John Hancock Investment Management, Boston, this morning. Lisa, the dynamics of the market across equities, bonds, currencies, commodities are tangible here into the Fed meeting tomorrow. I mean, in 7 basis points in the 10-year yield within the weekly volatility. Maybe it's collared, it's banded, but still there's movements in bonds, and I'm watching the relentless move of yen. Intraday dollar yen, we can show this on TV. It's a great intraday chart on radio as well, and the answer is up, up we go, and it just, I mean, I'm sorry, there's no bid on yen. There's nobody looking for a 149 yen this morning.
Even though there was a bit of relaxation in yield curve control, all things being equal, that could restrain inflation and actually allow the currency to normalize. On the flip side, everyone was expecting this, and that's what Mark McCormick said, and people were actually expecting that much more with respect to a guidance about possibly taking greater actions from the Bank of Japan.
You know, we'll see what they do overnight into 7 a.m. I think Farrell's going to be watching that. I don't know where he is right now, but maybe it's better time zone for him. We'll see that tonight, 7 p.m. Look to Asia, Bloomberg Radio and Bloomberg Television. But Lisa, to me, and Gilles Moet colored this, I mean, I don't think at the Lagarde press conference X number of days ago, we really thought about euro disinflation. There it is.
And that's going to be good news for the ECB. But we heard from Gilles Moet, and this I think is one of the salient points. Europe is taking pain as a result. The U.S., not as much.
Is it a live meeting tomorrow? It's a live meeting?
I mean, market's basically saying no.
We'll have to see. The Standard & Poor's 500 up 0.3%.
I say I don't think it is going to be a live meeting, Tom, just simply because the market right now is basically expecting them to stand pat. And there's no reason for them to move unless there is some massive surprise in the data coming up to that. I don't know, though, what that is. Are they still data dependent, or are they being driven a little bit more by a wait and see mentality with this belief still imbued that we are going to see the disinflation that we just saw over in Europe?
November 1, December, I think it's 13th or 15th, can't remember, January 31st of next year. 2 meetings out, seems like a year away. How does anyone model a guesstimate of disinflation for January 31st?
I don't know how anyone can model disinflation for the next year, or at least the next month. There is a real question, though, about whether the long end of the yield curve is doing the Fed's work for it. And I was looking at the Bloomberg Financial Conditions Index, and it has contracted somewhat material to a tighter kind of level. You are seeing it more meaningfully as credit spreads widen and as long-term bond yields rise. How does this feed into equities that have kind of been resilient? How does this feed into the global story? This is a confusing brew. That's all I can say.
Confusing
brew.
Next
year I'll do that for Halloween.
Thanksgiving and Halloween is, well, I mean, you know, we make a joke about it, but the toxic brew, is it a toxic brew with a VIX of 19.30? I'm sorry, that's not.
Does the VIX
we
still
shouldn't be in a panic or crisis if I look at the equity market. Period.
I think that that's a fair assessment. I think equities are not expressing panic, although it depends where. Take a look at some of the regional banks.
Regional banks. We'll talk about small cap as well. Lori Calvasina was warbling gaily about that yesterday. Coming up, his optimism on the market. John Stolfes, OPCO. Good morning.
London, in Sydney,
from Washington,
in Tokyo,
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching. You do not want to miss this story.
Is there the kind of upside?
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Good morning, good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to the Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
The only thing that I intend to have resign is Hamas. We're going to resign them to the dustbin of history. That's my goal. That's my responsibility. And that's what I'm leading the country to do.
The Prime Minister of Israel, Benjamin Netanyahu, there from Tel Aviv. He's been very active in the past 24 hours. We say good morning to all of you. Bloomberg Surveillance on radio, on television, on YouTube as well. Futures advance up 11. A better tape. Focusing now really on what we see in the currency market. Lots of action in Euro and Japanese dynamics. The yield, the 10-year yield in 7 basis points. Back and forth and back and forth.
Good way of framing
on the yield. Lisa, to set this up, I am benumbed by pictures of Gaza. I'm speaking as a complete hack and amateur that look like Aleppo. that looked like Syria from a complete devastation.
Complete
There's no other way to put it.
I would agree with that. Just entire neighborhoods taken out, flattened. And there's a real question about when this is going to end, how far this will go, and what it would take to really end this, especially after hearing Netanyahu saying a ceasefire is not in the picture. Bloomberg's Oliver Crook in Tel Aviv, Emery Herdern in Washington. Both of you joining us now, thank you. Oliver, I want to start with you. What does winning look like for Israel as they go deeper into Gaza?
I think that's a very good question. I mean, if we think about the figures that we've heard about how many Hamas operatives there are, 30,000, potentially, how many of them are they going to be able to get? And how do you really, how do you dismantle something that is really an ideology? And I think this is a question for many people, particularly as this ground invasion continues to get underway. And again, with all of the mounting pressures externally, I mean, we heard from Benjamin Netanyahu last night, really on the defensive, both as a defense of the Israeli nation and its actions in Gaza, where more than 8,000 are dead now, according to the authorities there, but also defensive personally, as alluded to in that soundbite that we heard from him. He was asked by a journalist, you're losing public support within Israel. Can you continue to lead? He says that the only thing he wants to resign is Hamas. But again, this is part of the equation for Benjamin Netanyahu, a prime minister under fire.
There's a question, Anne-Marie, about how regional players are really arranging. And we saw yesterday a Saudi Arabia representative coming to meet with U.S. officials to talk through some of these issues, among others. Do we have any sense of how some of the players with leverage who are able to negotiate are stepping in or trying to maneuver?
Well, I think what you can see and what's very apparent is that most players want to avoid a regional conflict. They want to avoid what is going on between Israel and Hamas from spreading, which is why Khalid bin Salman, the Crown Prince's brother and the Saudi defense minister, was here in the capital yesterday. It also came at a moment of heightened importance for Riyadh, given the fact that on their southern border, they have been dealing, and they did recently deal over the weekend with Houthis and missiles coming over from the Houthis, which are backed by Iran as well, the same way Hamas and Lebanese Hezbollah are backed by Iran. And what makes this incident more nerve-wracking for the Saudis as opposed to previous incidents. I mean, I've been in Saudi Arabia myself when Houthi missiles have come over. This is not something new. Before Saudis died in this incident. So you can see there's still frenetic diplomacy throughout the region. Tremendous amount of phone calls happened over the weekend, and now visits, because most of these players, especially in the Arab world, want to avoid a regional conflict.
Ollie, we keep thinking about the hostages, and the number keeps going up. We never really know exactly how many, and currently the number, I believe, stands at something like 240, as there is more clarity, and one person who was brought back to Israel yesterday. What do we know about how that's complicating things, not just with logistics, but also on a political level with the families of some of these hostages?
Well, we mentioned a number of the pressures that Benjamin Netanyahu faces. One that we didn't mention, which is very real, is that precisely that, is that basically can this military campaign, and particularly the ground invasion segment of it, does that jeopardize the safety and of these hostages that are being held by Hamas? Again, which a number which continues to change. And again, as you say, 240 is the number we got today after there was one, we understand, that was recaptured or somehow dislodged in Gaza over the weekend. But again, this is one of the many, many issues that they're dealing with. And one note that we need to make every now and then is we do not actually know how many of those 240 are actually still alive and how many are the bodies that are just being held by Hamas at the moment.
Emery Hardin in the debate is the voice of Robert Gates. All can agree he's an important voice with a legacy and institutional memory of his America, the former defense secretary, the former head of CIA. His article in Foreign Affairs magazine, Anne-Marie, is my read of the autumn. There's no question about it. It's an incredible, intense essay of the dysfunctional superpower, the dysfunctional beltway. Is there a middle ground in Washington that wants to get things done?
There is. When you look at the center of both parties, they definitely want to move forward. But when you talk about some of this paralysis we're seeing in Washington, you're going to see it in the next few weeks when it comes to aiding Israel. Right now, what you're going to see this week on Thursday is Mike Johnson, the new speaker, put on the floor aid to Israel. But to balance that, he's going to rescind billions of dollars that happened under the Inflation Reduction Act that goes to the IRS. What you are hearing from Senate Democrats is that this is dead on arrival. That's what Senator Patty Murray had to say, and she's the chair of the Senate Appropriations Committee. Ben Cardin says it's a poison bill. But more importantly, Tom, Senate Minority Leader Mitch McConnell yesterday was in Louisville at the university there, standing next to Oksana Makarova, the Ukrainian ambassador to the United States. And he has been staunch, forthright, emphatic about the fact that it cannot just be aid to Israel. It must be aid to Israel, Ukraine, Taiwan, as well as the southern border. So you're going to see a massive amount of Republican infighting over the course of the next few years.
The heart of the Gates essay, Anne-Marie Horton, is that the politicians have to educate America. Does America want to be educated by those looking for an international Washington, or is it a new isolationism?
I think it depends who you ask. What polls have showed since Putin's invasion of Ukraine is that while Americans did at first support Ukraine, there have been more concerns about how long this conflict is going to last and about how much money, U.S. taxpayer money, is being sent to Ukraine without an end goal or an end vision for this conflict. So the longer these conflicts drag on, the harder it is for politicians to sell them back home, because the number one priority for Americans right now, if you look at every single poll, is the economy. And when it comes to the economy, it's their concerns with inflation.
Oliver Crook, we are in tonight in the Eastern Mediterranean when things happen. What should we look for in the Israeli and the Levant evening?
Well, what's been interesting is ever since I came back on Sunday, there has been not a single air raid siren in Tel Aviv and in central Israel that I have heard, which was a regular occurrence 2 to 3 times a day. Again, this may be speaking to some of the depletions of the resources that Hamas has in terms of the longer range missiles. But again, what we're watching, Tom, is the same thing as ever, is that fear of escalation. But what does that actually mean? And in the form of Hezbollah, this is the 150,000 rockets that sit on the southern border of Lebanon. And this is really the trigger point that we watch here in Israel for a meaningful escalation.
Oliver Crook, thank you, from Tel Aviv, and Anne-Marie Horton in Washington this morning. Lisa, the multi-front of this, just in the time I took off here, there's been a radical shift in 4 days.
There's been a radical shift in terms of the expansion on some levels, but also the humanitarian crisis in Gaza. Also, this question around where the balance of support is in the United States, given some of the internecine battles over exactly how you deliver aid. It is such a difficult moment to parse that is incredibly polarizing around the world.
Balance of power tonight will continue to drive this forward. Sandan on Bloomberg Radio as well. A data check shows an advancing equity market off the joy of yesterday. Futures up 13. I'm at a 4,200 level on SPX, 33,000 on the Dow, 14,400 on the NASDAQ 100, up 0.2%. Dow leading the charge this morning. We've seen that in the last couple days. VIX from a 22 into 19.24 shows normalizing equities. A 10-year yield 4.82%, and the 10-year real yield is quiescent here, 2.39%. What I see, Lisa, is the amazing restrictive nature of the Bloomberg Financial Conditions Index. Will they cut rates tomorrow?
Yeah, they're not going to cut rates anytime in the near future, and there's really a question of whether this has moved away from the Fed's purview.
Purview. We're going to have purview tomorrow. The Fed decides. This is going to be important. Richard Clarida scheduled to join us as well. Brent crude, have not mentioned it this morning, $88 the barrel. Sonia Martin, next.
story did come around as something that's a bit different. There is a dark side to it.
It's hard to even talk to people about these chemicals and tell them, look, there's a chemical that's in you that's not found anywhere in nature.
We've all been used as guinea pigs for the last 70 to 80 years. We weren't told we were being exposed, but they did it anyway.
This right here is the shadow fleet. To actually see clandestine behavior was really surprising. That makes you think, well, what else is going on?
A lot of people let Agnes down. What she was told is exactly what happened to her.
It took the lid off a much bigger problem. I think that's probably the most shocking part of this whole thing.
Your grandfather was a famous basketball player. In fact, he's in the Basketball Hall of Fame. Did you have any of his basketball genes?
You know, in my family, David, you didn't do very well at the family barbecues if you couldn't play hoops.
Bloomberg Surveillance, Jonathan Farrell, Lisa Bramwitz, and Tom King. Mr. Farrell on assignment, as they say. On this Halloween, the Queen of Halloween is with us. She's going as Toxic Brew. I'm going as Yield Curve Control. We'll cover that here in a moment. Sonia Martin is scheduled to join us right now on the data front, and it is an eventful FX data today with the dollar flat, but significant, and I'm going to say historic moves in yen out to a $151 yen and a 161 euro yen as well, and the wait is on for some form of intervention, which I'm going to be honest can come in a set of flavors as well. It's not as cookie cutter as saying there'll be intervention. Sterling 121.85, euro 106.59 off some stunning European data. Brent crude 88 is a global price. West Texas down under $83 a barrel. And in the equity market, futures up 13. We need to look at movers. I'm going to suggest Friday, Apple will be a mover off Thursday evening earnings. Right now, JetBlue this morning, a mover. Caterpillar, a mover. And they are very outlooky in that even Caterpillar lifted on the headlines and then reversed on the outlook. People, Lisa, looking forward.
Yeah, it's
on movers and not liking what they see.
Yeah, it's order backlog falling, and that seems to be driving some of the action. It seems like the forward look is more important than anything else. JetBlue's forward look revised downward, which possibly is causing this big, significant sell-off. That said, outside of just the stock move, what I thought was interesting about Caterpillar, listen to this line. Caterpillar cites favorable price realization and higher sales volume. Basically, they're jacking up prices and still selling more.
So that's what McDonald's did yesterday.
Exactly.
We're taking the I have a Caterpillar Zamboni. It's really great.
We've heard about it.
It's great. Yeah, you know, it's really good. But whether you got a Caterpillar lawnmower or a bulldozer, why is it any different than a number 2 value meal at McDonald's? I don't think it is.
There might be some differences between a number 2 value meal and Caterpillar equipment. Nonetheless, we'll save that for later in the hour. Under surveillance right now, pressure growing for Israeli Prime Minister Benjamin Netanyahu to resign. Rivals have accused Netanyahu of refusing to accept responsibility for security lapses leading up to the October 7th attacks by Hamas. In a news conference yesterday, Netanyahu vowed to fight Hamas until, quote, the battle is won, and said calls for a ceasefire are, quote, calls for Israel to surrender. We've been covering this throughout the morning. I don't want to get into the conflict as much as how this is being read through to markets, Tom. This question of, are we seeing escalation? Well, yes, we are seeing escalation. There's fighting in new places. But is this something that's going to continue to cast a pall, a sort of depression over the whole world on an emotional and humanitarian way? Of course. On a markets level, TBD.
TBD, that's Bramo talk. That's like jargon for the street. TBD is pretty important here, and I guess you've got to look at the currency, but far more than that, I look global oil price, $88 a barrel, suggests to me that round trip off the Anks. Now that could change suddenly, and it even could change here into the Israeli evening.
Although we are seeing a bit of a lift over the past couple of weeks to gold, so that's one area to watch. The Bank of Japan, meanwhile, loosening its grip on so-called yield curve control, Tom's favorite Halloween costume. you. It remains the last global central bank to hang on to a negative interest rate, though, so they have a long way to go. After the bank's decision to hold rates, it announced it would allow more flexibility for the 10-year JGB, saying 1% is now just a reference point, and sure enough, yields climbed right toward that level.
Mark McCormick nailed this earlier this morning, that we think about export like the emotion for America is Toyota's being exported. That's from another time and place. It's about the imports they have to bring in with an ever weaker yen, a 40% depreciation over the last 11 years. Maybe it's been grinding, but could you imagine this discussion in America with a 40% depreciation of US dollar?
There's good inflation and there's bad inflation. There's also inflation that you just have to deal with, and you can't just ignore. You can't have Operation Ostrich, as John calls it. And at this point, are we seeing that realization, or are they not doing enough? It seems like the currency market is saying, we're unimpressed. Meanwhile, this story I know you've been following. Wells Fargo analyst Mike Mayo, always renegade, raising questions about bonuses given to candidates in the race at Morgan Stanley to replace CEO James Gorman. Morgan Stanley is awarding $20 million bonuses to incoming CEO Ted Pick, as well as runners-up Andy Saperstein and Dan Simkowitz, in a note to clients. Mayo writing that the succession plan is, quote, more reliant on comp than realized, and that, quote, paying top executives to stay raises a question about whether they are staying more due to compensation than culture.
I get this, and we're going to talk to Sonali Basak about this, folks, but, my basic take here on this is that's why they're there, comp. I mean, every bank could go, we're going to cut costs, but our top 15% people, we got to keep them this week. And I believe these two characters are, I mean, Gorman really went after me the other day. I mean, I'm like, should these guys stay? Should these guys go? And the executive chairman was all bent out of shape. And the bottom line is, I'm not saying they should stay or should they go, but they're not going to stay without compensation.
Unless they believe in the vision and the idea of this question of Dan Simkowitz and Andy Saperstein, Andy Saperstein in particular, being stiffed for the CEO job. I'm not saying that that's how it was borne out in the bank, but that was sort of one of the perceptions out there. They're basically bribing him. Stick around for a little while. That's
totally
one theory.
Disagree.
And I don't think you could agree.
Totally
honestly, I think a lot of people would agree with that. But Mike Mayo raising this question about governance.
We'll talk about this. Sonali Basak, as we look at the vision of an American Wall Street. Right now, the vision in foreign exchange. Sonia Martin joins us, foreign exchange and monetary policy head at DZ Bank. Sonia, what's your best trade in this turmoil? What is the to-do for Sonia Martin?
Well, good question. I think actually right now the dollar is interesting in the sense that we have seen some weakening of the dollar of late, and it's not just been against the euro. We have seen euro dollar rise again, just today is in particular. And I think that's not just because we've had some data out of Europe, which has been interesting, but I actually think the reaction of the market to the US data last week is an important signal. We had a really strong Q3 GDP reading, and yet the dollar failed to benefit. And, that's always a sign, I think, that, the market is priced in all of the good news and that we are maybe now primed for downside disappointment. So I think dollar weakness is something that we'll be looking at the next few months.
What should we watch is the distinctive tea leaf that will signal dollar weakness?
It's going to have to be a clear sign that all those pressure points that are working on the U.S. economy, and I think you mentioned them earlier on the show, interest rates are rising, mortgage rates, credit card debt is rising, credit card rates are rising. All of that is weighing on consumption. And so far, the U.S. consumer has been incredibly resilient, I suspect because of the strong labor market. But that's going to change. So I think that's where we need to look at. We need to look at signs that consumption is declining and that consumer confidence is declining. And I think that's going to be the signal people finally start to price in a somewhat weaker outlook for the U.S.
Well, that's exactly where I wanted to go. Gilles Moek earlier was saying that you can see Europe is taking the pain to get the disinflation that we saw today. It's not clear that the U.S. is. We just saw a massive acceleration in GDP, the biggest in almost 2 years.